Shaitanir Rajim. Bismillahir Rahmanir Rahim. As we begin today, greetings, traders. This is I, Abdul Shabazz, and this is some real change stock trading journey. And today, Thursday, March the 5th. Well, thank you all so much for tuning in, coming out. And well, let's prepare to do what we always do. Make some plans and get some money. So let's make some plans and get some money. Big shout out to the team for stepping in and joining us. Big shout out to the Kick team. Thank you so much for your support and continuing to follow us. Big shout out to the Some Real Change traders. Thank you for sharing your journey with me and with everybody else on the team. Do this every day, Monday through Friday. Big announcement coming next week. The class is almost completed. Class is almost completed. Amazing. Let's talk about money. Class is almost completed. Class is almost completed. We'll be announcing the dates very shortly. Excited about that. Coming into today, tell you what I want to see. Market is definitely coming down. I don't want to say definitely, but it appears to be coming down. Just a lot of bad news. Take our time with it today. Just take our time with it today. Very interesting. I see a nice put underneath that 681. I see a nice put underneath that 681. Nice put underneath that 681. $6.87 for a call. Plan's real easy today. That's what I like to see today. Let's go ahead and put a plan around these. Put a plan around this. Big shout out to those of you joining us on Kick. Grateful morning, grateful day to you. Okay, for that call, real simple. 686 strike. 687 entry. 689 4 first profit target. 690 6 second profit target. And for the put, again, 686 strike, 687 entry, 689 4 first profit target, 690.6 second profit target. Now, let's talk about the put. Let's talk about the put. For the put, 683 strike. $682 entry. 680 first profit target. 677.3 second profit target. Yes, there will be a third profit target today. 674. Could get real ugly today. It could get real ugly today. Again, these are my plans coming into today. You know, I make them and show them to you every day. Call 686 strike, 687 entry, 689.4 first profit target, 690.6 second profit target. Put 683 strike, 682 entry, 680 first profit target, 677.3 second profit target, and even possibly 674. That's right. It could very well get very, very ugly today. It's absolutely 100% possible. Now let's just move that over to the Thinkorswim charts and see how this lines up. Thank you for coming in. Thank you for hitting the like button. Thank you for kicking it with me on Kick, man. I appreciate y'all. The guys I got on here on Kick, man. Thank you so much. Alrighty, now let's pull up this larger chart and see what do we have going on. You can already see this beautiful controlled selling algo. Make it easy on your eyes. There you have it. We got the high, lower high, even lower high, lower low, lower high, and we are coming close to a double bottom or putting in a lower low. Don't know, but we definitely have lower highs coming into the day, and we have lower lows from post and pre-market. This is a controlled selling algo coming into market open, post and pre-market. With that information, let us look and see how our trading plans line up with what the chart is showing us. Again, stated on a 686 call with a 687 strike. That is 686 strike with a 687 entry. That is right here. So let us go ahead and put our alarm at 686. Break and retest of 686. It is time to start looking to get in for a call. We got an alarm set at 686.09. Looking for a break and retest in that area to potentially go higher. That does line up perfectly here with my trading view chart. That break and retest with the 686. Really want to get over that 686.5, moving up to the 687, and then take off. Got on a line here at the 687. This is ideally where I want to get in. Alarm at the 686. For the put, 683 strike, 682 entry. We take that knowing there is support here at 680, which is why even in doing that, 680 is the first profit target. From yesterday's bounce off that 680 up to the 687, we have retraced over 50% in that move. Let me show you here. Go from that to here, the highest point. Currently, the market is sitting At the 61% retracement, that is what I love. Anything underneath that, all of these bulls from yesterday are in a position to now start covering. So I absolutely like a break and retest with that 682, possibly even breaking this control selling algo to the downside. So I do feel good about that. So let's go ahead and bring those plans back. So again, those plans are 683 strike with a 682 entry. Let's go ahead and put our alarm right at 682.3. Looking for a break of this support, and then looking for the support level to be turned into resistance. After that, who knows? That is lining up here with my plans on my trading view, as well as my written plans. Calling out that 680 for a first profit target. Second profit target is 677.3. And yes, there is a third profit target today. There is a third profit target today. 674 potentially. Again, reminding you, this area is dangerous down here because below this 684, we are red for the year. And that could be some significance, especially with this month of March being what will be the end of the first quarter. To be red for the year at the end of the first quarter could spell disaster. I got to be completely transparent with the team. I am looking for a leap, a put leap for about a month or two, because I think I want to take advantage. If we get below that 674, that's a rug pull. Remember, I told you that. We get below 674, we red for the year. You might want to take a larger leap. You don't have to let it play out for the month, for the 2 months. You can take your profits anywhere within that time frame, but you want to give yourself room for that ebb and flow, because we're going to hit that 674. She's going to bounce from that as she did once before, because of the dangers of that area. You see that happen here before. We got down to the 669.8, and once we got there, we came right on back, but we are on our way back down. Very dangerous area. Key bulls am I looking to get money from? Who are they? Let's highlight them. I want to show them. Who do I think has the money? These bulls right here. And we want to neutralize them. And that takes place, right as I told you, at that 682 area. The opening bullish candle from yesterday will be in a position where they will have to cover. We get below the 682. If they cover and we have a measured move from this covering, watch out now. A measured move from this covering puts us at the 677, and that is also why we have the 677.3 as a profit target, because if yesterday's morning bulls have to cover, it will be a measured move, and that's going to bring us down to the 677. That is why that profit target is what it is. Everything is lining up for a potential disaster. It's absolutely an area of concern. In fact, I want to bring that back. Yeah, we're going to highlight it. Keep them them highlighted. All righty. Grateful day, top of the morning to you. Big Ben is in the building. Team is in the building. Let's also check that put area as well. And we love it. Alarm set at 682.04. Could happen quick. We want to see this turn into an area of resistance. If that happens, the market could be out of here. Already in a nice controlled selling algo, even to come into today with. Gonna be an exciting day today. It's going to be an exciting day today. And Kosie's in the building. Thank you for tuning in, teammate. Thank you for joining us. If you have any plans that you want to share with us, please feel free to put them in the chat. We are in a very aggressive selling algo right now. We have a larger selling algo and even more aggressive one since 8 o'clock. Definitely will be watching the news today as the market is being affected by World War III. Never thought we'd be saying that, but it is a fact. This is World War III, unfortunately. However, we still have to trade. Take advantage of opportunities as they present themselves to us. And that is exactly what the market is doing right now, presenting us with key opportunities. Todd Macon, what does cover mean to you? And what way are you using that, Ben? What way are you using cover? Oh, cover. Oh, when I said that, okay. When I was explaining this potential move here, whenever I take a trade, Ben, I'm looking at who's got my money. If I go into this, because remember, I trade who's in trouble. I look for stop out areas and profit taking areas for both bulls and bears. Whenever you come to those areas, it's going to be a high liquidity area. And that area is going to present some of the greatest opportunities to make some money. Now, that area for now is going to be underneath the 682. Okay? To be specific, 681.5. We just want to get really key, 681.5. Underneath the 681.5. All the bulls in this candle are no longer in profit. They have to cover their position, which means they have to sell. In order for bulls to cover, they have to sell. In order for bears to cover their position, they have to buy. So whenever I catch a bear in trouble, I flip to the bull side, because I know bear covering is buying. They have to buy those shares back. Whenever I see a bull in trouble, I flip to the bearish side and take a put, because in order for a bull to cover, he has to sell out of his position. That causes the market to drop. Now I'm looking at the size of the candle, and the size of the candle is helping me determine the measured move as far as how far that covering could potentially go. Based upon the size of this candle that measured moves brings us down to the 677.10 area. Again, nothing is exact, which is why I've chosen a 677.3 as a profit target with a 682 entry. First profit target is 680, because at 680 we run into another form of bullish support that has to be taken out. So very well could be a bounce at the 680, as these bulls here have to be eliminated. And if they are eliminated, it could create a domino effect. They start selling, then they start selling, then that put pressures on these guys. But even this measure moves brings us down to the 670, brings us down to the 674 area. And that is why I have for a third profit target today, possibly 674, from a domino effect of covering happening. Because think about this, along the way, this was bullish strength. Bullish strength. This candle to this candle to this candle, that's a lot of buying. That's a lot of buying. When they get in a, if they get in a position where they have to cover, that will produce a lot of selling. And we want to take advantage of that on the put side. It can happen very quick. It can be very disastrous. As I look even right now, we're already right at the area where I want to get in at. And we still have 22 more minutes before the market opens. This very well could be a disaster today. Very well could be a disaster. But that is what I'm looking at. And that is how I've come up with my profit target areas. Both of them. The 680 because of this candle here, which could present some more support. So we could come to 680 and bounce. We might not just go all the way to 674. We could bounce at 680 and then try lower for 674. We are definitely in a very, very dangerous area at that 674. 674 and below represents being red for the year. We want to be careful there. It could get very ugly. Very, very quick today. And because of that, teammates, because of that, yours truly, I'm looking at a longer term leap. I'm looking at a longer term leap. I'm looking possibly, I'm still day trading, but additionally on my other accounts, I'm looking at a month leap going out a month, 2 months. We get below that 674, it's a rug pull. It's going to be very, very interesting. You see right now we've already based right at the 682, because we know how serious that 682 level is, as I showed you on the trading view chart. A lot of time left, 20 minutes before the market even opens. As Quiet Soul enters the building. Yes, sir. 20 minutes before the market opens. We have two controlled selling algos. Let me show you. We have the larger controlled selling algo from post-market and pre-market that I've identified here in magenta. We hit that high of 677. After that, we started putting in a lower low, another lower low, another lower low. Then we put in a lower high. And now we're already at 682 again. This is either going to be another lower low or a double bottom. But now we're in a very aggressive selling algo since 7:30. Very aggressive that I've identified here in purple. It's going to be very interesting. Very interesting. And as you can see, there's that 680 level that I told you there's support there, which the market could very well hit this 680 and bounce as it has done in the past. So that's a nice quick profit from 682 to 680. And Ben, to give you a little bit more and the rest of the team a little bit more of an illustration, I spoke about and showed you, let me bring it here, these bulls in that first 30-minute candle from yesterday would have to start covering. Well, here they are, right here. And this is where that momentum will come from. Especially if they're in options, they can't even trade until the market opens. When they look and see that they're in a less position at the 682, they may start selling because some of them are still in profit. And in order to put that money in their pocket, they have to sell. That sale will bring the market down lower. We retest and touch that 680. Now all of the beginning bulls who were in profit are now at a break-even level. Some of them may even begin to stop out. You step on their necks with some aggressive bears, will blow through that 680 all the way potentially down. I see it's here. 677.2. I'm glad I saw that. I need to adjust. Let me adjust my plans real quick. Oh, I do have it. 677.3 is the next profit target. And then a third profit target could potentially be 674. And we really don't want to see it down at that level today. On a Thursday, going into a Friday, we really don't want to see that. Yes, sir. Again, calls, 686 strike, 687 entry, 689 for first profit target, 690.6 second profit target. And again, nothing is exact. We're talking areas and probabilities. For a put, 683 strike, 682 entry, which could happen right out of the gate. But we want to see this 682 turn into an area of resistance. Right now, it's an area of support currently. As we've seen some support here around 4 o'clock this morning at the 682, bounce from there. We're right back here now. We want to see this clear area of support turn into an area of resistance and come on down to the 680, 677.3, and unfortunately, the 674 is possible. Well, those are my plans for today. Alarms are set. We're just simply waiting now in about 15 more minutes to see exactly how this goes down. question for the team. Has anyone noticed any change in oil prices in your area? Has anyone noticed any change in oil prices in your area? Just out of curiosity. I'm reading the first headline. Stock market today. Dow slips as oil pushes higher. I've heard some reports. We're already under that 680. We're already under that 682. Now we've broken that support. We just want to see it come back and be used as resistance. Googity Bob, I told you it could get ugly early. We haven't even started yet. It could get ugly. I'm telling you, it's about to get ugly. And Kosey's saying move the put from 681.5 to 681.3 for his put. Yes, sir. 682 has been serious. It has been. Another alert at 680.7. Yes, sir. I'm right with you on that. I might have to move my down to it, Cozy. Because we've already blew past my entry at the 682. But I would like to see us come back and turn that area into support. But again, below that 681.5, it gets real ugly. I'm just using a natural area of support and resistance at the 682, and then the 681.5 is natural. Natural support and resistance is half and whole dollar amounts. 50 cents, dollar. 50 cents, dollar. 682, 681.50, 681. Those are natural support and resistance levels. Half and whole dollar amounts. We're also at the bottom of that larger selling algo that I have highlighted here in magenta. Okay, we're also at the bottom of it, but still in a very aggressive selling algo. It's going to be a very interesting day. So glad I'm here with you all. So glad I'm here to enjoy this. Let me see. Great day to everyone. Jared Lewis is in the building. Last time I went to get gas, it was $3.09. That was a couple days ago. Was that regular? It's got to be $3.09 regular. Because even here, our regular is about the same too, and I'm in Virginia. But it is saying oil prices are pushing higher. Very interesting day today. We still want to follow our rules and let the market play out. Allow it to show us where these trades are. We see the area clearly. We still have to be patient and wait for that nice, beautiful setup. Okay, he said yes, it is regular price. Finding support at the bottom of that algo as the market prices typically do. Typically find support less than 10 minutes before this party gets started. Alrighty. Thank you guys for tuning in, and let's get ready to do what we do best. Got my plans up, top left corner. My plans are in the top left corner. There's that retracement back to that 682 that I was looking for. Turning that 682 level clearly now into a level of resistance. And that's what we want to see. With 8 minutes left until market open, Beautiful move out of the gate. What a candle. What a candle. $2 move in that one candle. Broken the algo and doing its thing. However beautiful that move is, let's still keep in consideration that it's still contained within a much larger algo. So this move here has been nullified. Beautiful breakout. But it's still contained within this much larger algo. Not only that, but I extremely like it now if she comes back down. Re-putting that alarm back to 682. Still want to see the same thing. Turning to 682. See, it didn't act as resistance. It broke it. But instead of acting as resistance, it went right back through it. So still supporting this as support. This was a false breakdown. Right back to that 682 where that support has been. Right back up. But still keep in mind that unless it breaks above the 685, this is still within a controlled selling algo. This will simply just be a lower high. Again, our last high in this area is 685.7. Anything underneath that is still a lower high. And as always, as I've been doing this month, I will be putting up CNBC.
Accelerate. Kroger,
Costco's
they
had a
did
great
guide below on full year comps. Yeah.
Right, Kroger already.
They're floundering.
But Costco stock price, you see right there, 15% this year, more than Walmart. It's had a very good run.
It got clobbered last year. My trust has owned that basically since my trust started.
In that anti-AI moment where everybody was pulling out of software, Costco was certainly a beneficiary.
And as Carl mentioned, the re-ups were not as good.
They've been decelerating slowly.
Right, they have, and that's not good. And they say it's younger people who do e-com. You know, the money from e-com really does fall to the bottom line of Amazon and Walmart now. I mean, Target's trying.
We got some decent number. Actually, American Eagle was a beat, though the stock was down pre-market, Jim. Burrow looks pretty good. They upped their comps for the full year.
Yeah, look, when you have these off-price guys in this market, they're doing really well. And I come back and say, well, that again is a sign this economy's not that good for half the people.
Yeah.
It's not. And when you see these out, like TJX had a great quarter, you say to yourself, everybody got too expensive. But then I'm interviewing Tapestry today, and they have a nice price point, affordable luxury. I remember when there was a judge who said, well, FTC decided to go out and said that there had been an affordable luxury. Remember that with Tapestry?
I do.
What was that? That was genius.
Yep, they didn't get it. They didn't. Yeah, the deal was turned down.
How great was that they didn't get it?
Well, they were happy, I think, right, in many ways, because the business had deteriorated during the period of time that they were in litigation.
Is it better to be lucky than good?
Always.
Always.
And in fact, that's the case for most most business people, most hedge funds, most everything.
Joanne
They
is
just
more
don't want
than
to
lucky.
acknowledge luck, or at
She-
least the ones who I don't like don't want to acknowledge
well,
luck.
she turned around Coach, which is really an amazing
Yeah.
thing. You have some people who do these brands.
But well, you mentioned Ross Stores yesterday during the
love
Mad
Ross
Dash,
Stores. I love
right?
Ross
And that had a
Stores.
very good quarter, and that's been a strong stock.
They do
so.
that pack away. Ross Stores has a lot of stuff that looks like it's expensive.
Yeah.
That's what they do, a lot of mimicking. Whereas, like, you go next door to TJX and they have the stuff that wasn't. Well, I don't know if they're going to get the Saks stuff. A lot of people feel they'll get Saks.
Of course, the labor market has huge implications for retailers. I think B of A tomorrow on tomorrow's print is around 35K. Although today Apollo suggests that some of the survey data means maybe there's some upside surprise in store for jobs tomorrow.
Well, it's so funny. I mean, I had a company that builds data centers, and they said, look, we don't have any electricians in this country. We're no spare electricians, no spare plumbers, by the way, no spare tradespeople. And I wonder at what point do people just say, you know what? I want a job where I can make $150,000 coming out of school. I want to be an electrician. And that hasn't happened yet in the country. They're still going and being liberal arts. They're still going
Nothing
and
wrong
being
with
English
liberal
majors.
arts.
English
What's wrong with being an English major? Actually, I think it's more
generally-
valid now than it probably was a few years ago.
Developed economies tend to gravitate toward services and.
I wanted to be
What's
an
wrong
English.
with being able to actually, understand underlying and
I
make
wanna-
analytical arguments and understand things?
I got an offer to be, there was a soft offer to be an assistant professor in history at MIT. And my father said, do you think we sent you to Harvard so you could make no money
By the way,
at a school that doesn't have a history
what are you
department?
advising kids to major in these days with AI coming potentially for so many jobs out there?
Well,
Maybe.
Well, I think that, I still think you get a job. Why, you think comp sci is no good anymore?
I don't know.
Coding?
Right now, the numbers are okay for comp sci,
you
but
would-
one would expect with software writing software that there may be some
Well,
challenges
you go
ahead.
into engineering because I would go into engineering.
Really, even though the AI is going to be able to do it all?
Yes, because I think engineering, you get a job with Jensen.
Get a job with Jensen. He's going to employ everybody.
Everybody.
When you have 75% margins, you can do that.
Yes, you can.
Just employ everybody. Guys,
Comp sci is where the problems are, I think.
Well,
But you
if-
can't go to Harvard and become an electrician, or maybe you can. I don't know.
Well,
why is Salesforce
I don't
going up?
know.
I thought Salesforce was going to be finished. You told me we wouldn't be safe in Salesforce.
it wasn't a bad call for quite some time there, actually.
Well, but
to
the stock
not be
went from,
safe
it's just
in
went from
Salesforce.
181. Maybe it was something he said to Sarah.
You will find out because
Maybe
Sarah
it was
did
Sarah.
interview him yesterday, and I think we're going to be featuring a lot more of that interview later on Squawk in the Street as well.
Mark's talking to everybody.
From Benioff.
I'm on a chain with Mark.
Yeah,
Mostly fun.
that's good. Guys, if as a year from now may be the case, who knows, Anthropic and OpenAI were public companies, we'd be talking about them a lot because, of course, we like to put up stock charts, but also they'd be moving. I mean, it is not often that you
He's so
see
great.
the kind of vitriol, certainly coming from Dario Modet to Sam Altman and maybe back and
then
forth.
Tell me one that's been like that. One. I can't
Well,
think
I
of
mean, Musk and Zuckerberg went at it pretty hard a few years ago. Remember, they
That's
were going to have a caged match in the Roman Colosseum.
Right.
So that was interesting. But this is also, I mean,
They're
here's
so
more
public.
from this letter that has been shared by the information that was sent from Anthropic CEO to employees on Friday, talking about Sam Altman. He's trying to undermine our position while appearing to support it. I want people to be really clear. He's trying to make it more possible for the administration to punish us by undercutting our public support. And finally, he says, I suspect he's even egging them on, though I have no direct evidence for this last
It's
thing.
incredible. It's incredible how ill-advised it is to do that. It's incredible. You can't personalize it. Say, look, I think they have an ill-advised strategy. I think they have a suboptimal
But you would
strategy.
agree that having corporate principles that can't be broken is okay.
Oh, no, I'm totally okay with that. I just think that why go out of your way to say that this man's a liar? Let that be decided by everybody.
You do know what Emil Michael said about Dario, that he was a liar.
I know.
That's sort of.
Yeah, he did say he was a liar. I mean, but you look. I guess what David started with by saying it's a different time. Everyone's a little more. There's more visceral. It's more visceral.
And it comes
It's not
back to,
Harvard
do we have
versus Yale.
this as
We
well?
continue to mention Harvard.
It comes back to this issue again around the use by the Department of Defense of their technology to do things that Anthropic said you can't do. Mass surveillance and autonomous weapons being not controlled being controlled by the AI. So he
But once-
explains it a little bit here. You know, our senses and these approaches, they don't have zero efficacy, but he calls it, this is the approach of OpenAI, 80% safety theater. He
Get
says
ready,
the basic
team, get
issue
ready.
is whether a model is conducting applications like mass surveillance or fully autonomous weapons depends substantially on wider context. A model doesn't know if there's a human in the loop in the broad situation it's in for autonomous weapons. It doesn't know the provenance of the data it's analyzing, so it doesn't know if this is U.S. domestic data versus foreign, doesn't know if it's enterprise data given by customers with consent or data brought in sketchier ways. So that kind of gets at least to explain what was at issue.
He should have gone one step further. I had George Kurtz on from CrowdStrike, and he said that everyone feels that these agents are terrific. Don't worry. There are agents that are able to learn how to get around what's wrong.
Yes.
And without any programming by humans, I would worry about what he's talking about.
I think that's what's really interesting is it's one thing to sell the government a good. It's another if that good is a living, breathing, improving thing over time that is not contained, right?
Right, and Anamode has written extensively about that threat. Obviously, that essay he wrote about a month ago, or not long after he got back from Davos, about bioweapons and his concern there, and about some of these very things, because, as he said, we still don't fully understand why the AI does what it does.
Well, don't you think that the government would be a little more responsible by saying, you know what, we got to look into this. Maybe let's bring in someone like George Kurtz who's saying, wow, these things, they just learn from each other and they learn to get around the guardrails. I find it interesting. You know, look, this is not when Jensen showed me these electroset dogs that could pick up Jell-O cubes, and he rewarded them, the ones that got to eat it. This is not Jell-O cubes.
No, this is not that. This is vitally important to the overall safety of the country.
Can you imagine if this is?
No, there should be a broader debate about this, but the race condition that exists between our country and China is such that we feel we have to move forward as quickly as possible.
I know, but we got to realize these things are so smart that they can teach each other how to get around the guardrails. I think he's got a good point. They should be worried.
Jim, we briefly mentioned the layoffs at Morgan Stanley yesterday. It's about 3%, I think, right?
Yeah, you wanted them to say
$83,000 employee, 83,000 number of employees. Yeah.
Now I think people at home would say, well, listen, they made all this money. Why do they have to do that? But it is not unusual for firms to cull. It is unusual.
No.
Right?
No, and it wasn't clear at all that it had anything to do, Carl, with AI, because of course that's where our thinking goes immediately whenever we see a layoff announcement.
Right. We did get Challenger numbers, which for the first 2 months of the year actually aren't that bad. Lowest since 22. No. But the locus of the pain, Jim, has been in tech and transports actually. On diesel, on fuel costs.
All I know is that if you get in at FedEx, they're the winner. Just buy FedEx. Just keep buying FedEx. Raj Subramanian is just crushing it. By the way, speaking of crushing it, there was a note today about Apple and how Chinese sales were down in January. People, of course, take action on every single data point of what someone hears about Apple. I say people should just own Apple, don't trade it, because people have lost so much money with these kind of data points, and the data points about, the supplier seems to have come.
Yeah, and some of these, this new product push kind of got lost in the news.
And I want to get one. I mean, I can't wait. Wow.
Guys, finally, real quick, I don't know if we've taken a look at StubHub. The Penguins are out in force on this one. Downgrades galore with a not good quarter, not great guidance. This is a company that went public not very long ago, and it has not been an IPO you wanted to own.
Do you think it's in any business development book?
I don't mean their debt. I don't know what.
The private debt must be with which one?
It's not private anymore, StubHub.
Right.
It's
public.
But
I was being facetious.
That's why it's down another 10%.
When you look at that Blackstone fund, you really do see some things that you Razor Group. I don't think that Edmentum has any momentum.
It's a BlackRock.
BlackRock. I'm sorry. Home Renovo seems to be. This is a company. Well, some of these companies, they use this thing chapter. It's like, is that like English chapter, say 7?
I don't know.
Because I was reading, when I was reading Bify's book, chapter 7 did everything better.
Oh, good. I'm glad to hear that.
Look at the chapter.
I haven't looked at chapter.
I'll look at chapter 11. It's supposed to have some interesting things.
Watch bonds today. It will be important as the 10-year gets back to 414. I don't know if we got back to 415 this morning, but that is obviously almost a 1 month high. Breadth is negative, although the defensive sectors like healthcare and staples both down 1 to 2%.
Oh my, yeah, really big. I should have flipped out of some of that Procter & Gamble had a chance.
We're back in a minute. Shares of Robinhood have been volatile, although up 15% in the past month. Today, they launch a product that targets a higher income consumer. And tomorrow at 9:30 a.m. Eastern, Vlad Tenev will join us live at Post 9.
Ours?
Yes.
I'm going to bring my black card.
Yeah, we'll talk about this.
Rock, paper, scissors, man.
This premium credit card, as well as its ventures fund, slated to go public here at the Big Board Friday. That fund allows retail investors to get in on some private companies. Look forward to that conversation. Dow's down 400. We're back in a minute.
Very interesting start to this morning. Very interesting start to this morning. We'll remain patient and diligent. Two areas identified on the chart for a call, other one for a put. Plan still intact. We're still intact. Patience is all that's left and required.
Let's get to Jim and stop trading.
There's a huge rollout at Bank of America on the companies that we often talk about as MasterCard, Visa, Affirm, Klarna, Block. And I would point out that they like every single one. The one that I have felt is for people who don't want a lot of risk is MasterCard. It's got high growth. It does a really good job. MeBot's good. And if you want more, a little bit more risk, then go with Affirm. I would not go with Klarna. I think Klarna is not the buy now, pay later. I don't want it. If I take it, I'll get something from Affirm. But Max Levchin, I think, is a genius, and Affirm's really at a great level.
Yeah, Visa's the one they put on US 1.
Yes, and I think that Visa, while good, is not as I think that MasterCard's run a little better right now. Not much, but I like it.
Looking forward to your conversation with Blankfein tonight.
Yeah, Lloyd, I find the book very, very controversial, and people, and I mean it. I mean, there are people. There's some score settling done with say Vikram Pandit doesn't look that good in the book, and there's some gaps in terms of saying that such and such person was great. I'm probably not dwell on that because I worked at Goldman, but suffice it to say, it dishes, and the person it dishes the most on is Lloyd. Very self-hating.
Oh yeah.
Very self-hating.
Jim, we'll see you tonight. Mad Money, 6 p.m. Eastern Time. S&P down about 16, not quite to the lows, the opening lows of yesterday. Don't go away.
Good Thursday morning. Welcome to Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla and David Faber. We are live as always at Post 9 of the New York Stock Exchange. We've got two cannot miss interviews coming your way. Just a moment. Paramount Skydance CEO David Ellison will be with us live from the Paramount lot in his first interview since the company beat out Netflix in the battle for Warner Brothers. Plus, we will hear from Salesforce CEO Mark Benioff. His stock climbing today, but down more than 20% this year on fears that AI will eat into the software business. But guys, let's return to the economic data because it is a jobs week. We get the big jobs report on Friday, and we have a lot of good sources of information showing that the jobs market is okay. Is in decent shape. Okay, so let's start with this morning. We got the weekly jobless claims number, so the number of Americans filing for unemployment claims. Guess what? It was a little bit better and still continues to paint a pretty okay picture where you're not seeing any kind of spike in layoffs. Jobless claims came in at 213,000. 215,000 was the estimate, so it was better than that. 213 was prior, so it stabilizes. The 4-week moving average, just to smooth out all the weeks of all this noise, down to 215, which is actually a 4-week low. That is good news. It means that companies aren't picking up their layoffs. And we had another piece of good news on that front as well from the Challenger Gray and Christmas. This is the private sector report that does layoff announcements. And here's what they said: 48,307 job cuts in February. And that was down 55% from January. This is clearly a volatile series, down 72% from the same month last year. So really, the whole low hire, low fire kind of narrative around the jobs report holds up with this layoff data. And then on the hiring side, so that's the layoff side. On the hiring side, Carl, we didn't really talk about it, but ADP yesterday for the month of February was good. 63,000 jobs added in the month, 50K expected. It doesn't necessarily correlate that well with the monthly government jobs report, which we'll get tomorrow, but it's just good information. And I think it reinforces the Fed's characterization of the labor market, which is stable.
Yeah, although of the 63, as you saw, 58 was education and healthcare. We lost 28 in financials, professional business services. It's all sort of still resting on one big pillar.
Yeah, which is sort of like healthcare, education services. Construction was a real bright spot. That was good. Obviously, there's a lot of people needed to build data centers, right? But for sure, a lot of it is focused on that education, health services part of the economy. I would also just point out in that number, the wages were pretty solid, unchanged. And just from the data, what ADP said was, we've seen an increase in hiring and pay gains remain solid, especially for people who stay in their jobs. So overall, just a solid read on February jobs if there was any anxiety that the jobs picture is getting worse, which is out there. I mean, people are wondering about that because we haven't seen the kind of hiring numbers that we saw in the last few years.
It is pretty encouraging. Maybe now the worry is back to inflation. Barkin on the tape today saying maybe this fight is not yet done. We've already talked about gas prices today. And we know what core PCE did. We know what PPI did. Some of these ISM numbers.
Let's see, let's see, because any time in the last year people have gotten overly worried about inflation, it comes out better than expected. We're sort of stuck around this 3% level or just below that on inflation. We don't want to see it go higher, but let's see what we get from the data. The only other piece of information I would add, just because we talk about every day the AI impact on the jobs market and whether that's real or not, the Beige Book. Love the Beige Book. It was out yesterday from the Fed, all the anecdotals, right, from the different districts. Firms in some districts and in various sectors look to AI or other forms of automation to gain efficiencies, with most emphasizing the goal of productivity enhancement rather than replacement. So investing in AI to make workers more productive, but not to replace them. And that was, I thought, a good little thread.
That would be a good sign if that continues. And that, I think the question becomes, at what point does that sort of turn from
they're so productive that we don't need them.
Helping them to replacing them. That said, when it comes to this bigger question of software and everything, Claude replacing everything inside internally for a company, I'm certainly getting plenty of pushback. I'm sure you did when you talked to Benioff yesterday as well. But sort of mission critical, ripping stuff out of a company, it's definitely not an easy thing to do, and it comes with a lot of question marks.
Well, especially now that Claude is blacklisted as a supply chain risk by the U.S. government, but also just in general, agree. I mean, that's what I hear. We even talked Benioff and I, and you'll hear a little bit more about this, about the block layoffs, right? 40% of the staff, and whether that was indicative of the new reality. He kind of said, we all know that problem has, that company has problems, and that's
Right.
kind of a unique case. It's not what Benioff is seeing, even with the stock drop. He's, he's hiring stable.
Meantime, getting a news alert out of Washington today. For that, let's turn to Eamon Javers. Morning, Eamon.
Government is calling for an end to military operations in the Persian Gulf. I can tell you that I've just been texting back and forth here with the spokesman for the Chinese embassy here in Washington, D.C., Liu Penggu, and he texted me this statement from the Chinese government. He says, the Strait of Hormuz and its adjacent waters are an important international trade route for goods and energy. To keep the region secure and stable serves the common interest of the international community. China urges relevant parties to immediately stop military operations, avoid further escalation of the tense situation, and prevent regional turmoil from causing greater damage to global economic growth. That's a statement from Liu Penggu, the spokesman for the Chinese embassy here in Washington, sent to us at CNBC just a couple moments ago. Clearly, guys, the Chinese have a lot at stake in all of this, as well as they watch oil traffic now shut down out of the Persian Gulf and wonder how long that is going to last. And they are now calling for an end to military operations in the region. Back over to you.
Not entirely unexpected, Eamon, given
That's right.
what we know about vulnerabilities throughout Asia when it comes to energy, for certain. That's our Eamon Javers. Let's move to the broader markets and a mixed start to this session. Joining us today, Scott Cronert, U.S. equity strategist over at Citi. Scott, it's good to have you back.
Hey, Carl, good seeing you.
To Eamon's point, whether it's security or energy, this U.S. ex-U.S. trade has definitely gotten unwound a bit in the past few days. Does that continue?
I think it does. I think the U.S. actually comes through as a bit of a safe haven as we continue to go through the tumultuous
Still
events
no reason
there.
to be involved in anything.
It's quite interesting. You
Still
look at
no
a lot
reason
of the
to
flow
be
action. We
involved
monitor ETF
in
flows
anything.
And the amount of money going into international over the past month or so has been outstanding, right? It's been very high levels, highest we've seen. So I think the point I make is there's been a rush to broaden one's exposure away from the U.S. growth cohort as we've gone down this AI productivity to disruption path. The rest of the world has looked better, but now as you go down this conflict route, all of a sudden the U.S. becomes a little bit more of a safe haven relative to the energy impacts in other areas of the globe.
Right. Per our discussion with Sarah a minute ago, certainly doesn't help our fight on inflation. Are you starting to run new models on corporate margins at least?
We're not. We're looking at this probably as still a net margin additive. But again, this is still very early innings, and it's going to come down to duration of conflict, how high oil prices go, and then how stubborn they are at those levels. But what I would say is that, again, relative to the rest of the world, U.S. probably in a little bit better position, something closer to energy independent, if you will. And then what I just would keep coming back to is that the inflation concerns are real on a shorter term basis. Again, on this AI productivity potential disruption issue that had been front and center up until the past week or two, that in our view is still an inflation limiting factor as we go forward. We still think deflation risk is probably the bigger concern as we go forward a year or 2 years from now. With the AI build-out continuing.
All right, that's quite a statement with Brent crude now at just surpassing $84 a barrel. But David Rosenberg of Rosenberg Research recently did a study showing every time we saw an oil price spike, and there have been a number of them over the last few decades, yes, a little inflation in the near term, but a year from then, it was all the way back down, and if not lower. So ultimately, it is just a volatile spike that does not last.
That's the way we're looking at it. But again, that's why duration becomes so relevant in terms of the magnitude of the conflict and how long it goes. We took a look at the 2011 Libyan situation as a case that's kind of interesting. It was early when it unfolded. It was 12 days. It was airstrikes, no boots on the ground. And you saw a similar response. You saw oil spike up, right? But then it did fade in the weeks after the end of that situation. But then you saw the rest of the year to play out. And the rest of the year led down a little bit different economic path with global debt crises, if you will. So, we're viewing this as somewhat compartmentalized for now. But again, there's still a lot that we don't know about how this is going to ultimately resolve.
Finally, Scott, on consumer, I mean, I know it's pretty well trod ground, retail gas jumping, 20, 30, 40, 50 cents in a few days. But at what point does that begin to maybe pinch some consumer discretionary?
It's going to happen. I think, if you look at what's happening within the retail world, I think that the aggregate data and the earnings picture remains pretty good, right? But what you're still seeing is a fair amount of trade down effect. And, we've been arguing for some time that the consumer is getting close to a stretch point, if you will. It's one of the reasons we've been underweight consumer discretionary and staples all year, if you will. What I would say on this, though, is that I think as we go forward, we still have to allow for this ongoing labor disruption issue. So again, time frames always matter to me, and shorter term, yeah, we have to be attentive to what happens at the gas pump, what happens in terms of the inflation expectation read through. Longer term, we're concerned about that labor condition as AI productivity and potentially disruption plays through. But that's sort of a 1 to 2 year story. Again, that's not going to be helpful in terms of navigating the here and now.
All right. That's one reason why tomorrow's important, and maybe next time we get you on some chips and software. Scott, good to see you.
Okay,
Scott Conant over at Citi.
Here's our roadmap for you for the rest of the hour. Still ahead, Salesforce CEO Mark Benioff tells us what he thinks investors are getting wrong about the AI software disruption story. Speaking of, as his stock gets a lift today.
Plus, Paramount Skydance Chairman and CEO David Ellison is with us exclusively. It's his first interview since Paramount prevailed in the battle for Warner Brothers Discovery.
And Broadcom trying to do what NVIDIA couldn't, holding on to a post-earnings bump. We'll look at what the street's excited about from that quarter in just a minute.
The months-long battle for Warner Brothers Discovery coming to an end last week. Paramount Skydance emerging victorious after Netflix declined to raise its deal or its offer for the company. The decision clears the way for Paramount to acquire Warner Brothers in a deal valued at $31 a share in cash. It caps off one of the most closely watched and fiercely contested takeover fights the media industry has seen in many years. Joining us now in a CNBC exclusive is Paramount Skydance Chairman and CEO David Ellison. He's in Los Angeles. with Julia Borston. Julia, take it away.
Thanks so much. And David, thanks so much for having us here on the Paramount lot to talk about this historic merger. You are going to be paying 63% more for Warner Brothers Discovery than you first reportedly offered back in September. Tell us, what is your response to concerns that maybe now you're overpaying?
So first, I just want to let's zoom out. Like, we are incredibly excited to be here today. You know, I believe this deal is basically, you know, it's pro-competitive, it's pro-consumer, it's good for the overall creative economy, and you know, we really believe in the value of what we're going to be able to create here. If you go to 10,000 feet, let's talk about what's required to really be able to win today. And the first thing is you have to be able to win in content. By uniting the iconic, basically, libraries of Paramount and the iconic libraries of Warner Brothers, we now have a library of 15,000 films, everything from Harry Potter to the DC Universe, Mission Impossible, Top Gun, and The Godfather under one roof. That puts us in an incredible position to really be able to win in the content space. It immediately gets us to scale in streaming. When you put Paramount Plus and HBO Max together, you get to over 200 million, basically, gross subscribers. That'll come down a little bit, basically, with the overlap, but it puts you in the position to be able to compete with the leaders in the industry. And we've also repeatedly said that we really need to become one of the most technologically capable media companies. We're using technology to transform every single aspect of this business, and we're going to rationalize the cost. And at the end of the day, we're owner-operators. We're the largest shareholder in Paramount. We're going to be the largest shareholder in the combined company, and we could not be more excited about the future and our ability to really create value for all of our shareholders.
So it sounds like what you're saying, it was worth paying up and increasing your offer because acquiring that scale and securing that kind of scale in Hollywood right now is so essential. But at the same time, what comes with that is a lot of debt. And post-closure, the company will have $79 billion in debt, which has raised a lot of concerns, including from the likes of Fitch, which downgraded Paramount to junk status. How do you address the constraints you're going to now face when you're a non-investment grade borrower?
So I think, you know, obviously, yes, we have the debt, and let's actually contextualize that. So you also have to look at the cash flow. This is a company that's going to generate over $10 billion in cash flow, $69 billion of revenue, and $18 billion of EBITDA on a synergized basis this year. We'll be 4.3 times levered at close for the $6 billion in synergies. I think if you look at our track record and the ability to really execute on the synergies for the deal, when we signed the deal for Paramount, we announced $2 billion in synergies. When we actually closed, we were at $3 billion in synergies. We'll execute on over $2.5 billion by the end of this year. So we have the ability to basically manage that and deliver on the $6 billion. I want to be clear, it's not the 16 that some people have reported. It'll be $6 billion in synergies. And with that cash flow, that includes us actually spending more on content than any of our peers. So basically, we're going to be able to use basically that capital deployed towards content, deployed towards technology, to be able to grow and scale the business. And we also have the cash flow to be able to manage the debt and ensure that we're investment grade 3 years after closing.
So that's that balance that you're talking about here, the balancing the content investment with also managing leverage is something that investors have talked a lot about as your key challenge going forward. Because if you're going to be able to invest what it's going to take to compete on the content level to make the 30 movies a year that you're talking about, how are you going to do that simultaneously while also managing leverage?
So it's what we said. You actually have the ability to be able to do both. And I think if you look at where the Warner Discovery merger basically, really kind of got into trouble is that linear declined faster than people anticipated. They actually over-delivered on their cost saves, but linear was declining faster. I think that linear decline curve is now incredibly well understood, and we've taken a very, very conservative view to that in our models to ensure that we never get into a position where that's not manageable. And given the $69 billion in revenue, the $10 billion plus in cash flow, we feel confident in our ability to be able to manage the debt. Again, we'll be at investment grade basically within 3 years, and also have all of the capital that we need to invest in content, to grow our creative offering, to make 30 movies a year, to compete in streaming, and also to invest heavily in technology. And
in terms of that $6 billion in synergies, there's a lot of concern here in Hollywood, and there's been a lot of talk about how many layoffs might be part of that. Can you give us a sense of how much you're planning to eliminate jobs at a time when you can rely on technology to replace a lot of functions?
So look, we will absolutely have to rationalize the overall corporate overhead of the company, but that's not the primary driver of the synergies in the deal. Just when you look at it, we're going to bring HBO Max and Paramount Plus together. That will rationalize the tech stacks. There's incredible savings there, as well as in our cloud rationalization. We're going to rationalize the real estate footprint of both of these companies. We're not going to sell either lot. Those are iconic, and we are going to absolutely hold on to those. And look, another example that was not talked about is really procurement. When we originally signed the deal, basically to acquire Paramount, it was estimated at $50 to $100 million of procurement savings. The reality is it's well in excess of 5 times that. So there are several buckets in this business to be able to operate it more efficiently, to achieve those savings, and still ensure that we can invest in growth and always compete.
David?
Thank you, Julia. David, it's David Faber here in New York. Back to the linear cable networks and the comments you just made in terms of having a plan in place that assumes that it continued declines. I'm just curious. I mean, you guys spent a lot of time shooting at, obviously, the overall value of the potentially spun-off entity for the Netflix deal. But you own a lot of cable networks. I mean, you really are confident that the projections you have for what is these continued declines in linear cable and entertainment assets in particular is sufficient to deal with anything that comes your way?
So, David, the short answer is yes, we do. And look, I also think you have to contextualize that statement. We had a tremendous amount of questions on spinning off the linear assets during the deal with $17 billion of debt, given the decline of cable. I also think, as we've talked about, you really have to basically separate broadcast and cable. CBS is an incredible reach asset and, is an incredibly healthy business. We have 8 of the top 10 shows on broadcast. We just had the best year we've ever had in the history of the NFL in terms of viewership. We could not be, with Y Marshall's basically this past weekend and Tracker, we had a phenomenal debut in expanding the Taylor Sheridan universe. And also, when you put all of these portfolios together, we absolutely believe that we can bend the decline, basically, of cable. We can rationalize the costs, and we can actually keep those brands healthier for longer. In addition to that, there are several iconic brands, both at Paramount and Warner Brothers, that we will transition to streaming. So we see really significant value there.
You mentioned the NFL, of course, such an important provider of content for the CBS network. A lot of reports have them reopening negotiations for the next contract. And, of course, the expectation is the number is going to go up substantially for your company and many others who broadcast the games. What are your expectations there in terms of what you're going to have to pay for the NFL and how that figures, again, into some of the questions Julie is asking about your overall leverage and the financial health of the company?
Yeah, no, David, absolutely. So we have a phenomenal relationship with the NFL, and we anticipate that continuing for the foreseeable future. Genuinely, they are one of our most important partners, and we plan for them to stay one of our most important partners, having just delivered a historic season really in partnership with them. And, ongoing negotiations, we're not really in a position where we can comment. I promise we'll share something as soon as we have something to say.
But you do expect that you're going to be able to withstand what might be as much as a 50% increase in the overall cost of the NFL?
Again, on specifics and ongoing negotiation, I really can't comment on that. What I can tell you is we do plan to continue our relationship, and I do believe we have planned accordingly there.
I want to ask about the regulatory front for the deal itself. Of course, something I focused a lot on, and you guys focused a lot on when it came to your competitor, Netflix. You guys are all good in the U.S., but the California State AG, I'm told, may pose a problem. Not because they could make a case, David, that necessarily would win in court, but they could potentially delay your deal. File a lawsuit, maybe even get a temporary restraining order that could push you another 6 to 8 months, further out, particularly given the potential for job losses in California. How do you view that? How do you view the threat from the California State AG in dealing with it?
Yeah, no, absolutely, David. So first, let's just contextualize exactly where we are today, which is our HSR waiting period has expired in the United States, which means that if we were cleared everywhere else in the world, we could close in the U.S. tomorrow. We've received regulatory approvals in basically Germany and Slovenia, and we have been engaging since our tender with really regulatory bodies, with the regulatory bodies around the world. We've done that across the EU and in LATAM. We're obviously, we've met with all the Democratic state AGs, we've met with the Republican AGs, and we're going to continue to basically collaborate, obviously, with regulators throughout this process. In terms of basically, whether or not they can slow us down, as I said, we could technically close tomorrow, but also at the end of the day, we're all governed by the law. And the reality of this is there is nothing in this transaction that trips anything that would create cause for concern. And again, if you look at what we've done historically from a job creation standpoint, since we've been at Paramount, we've greenlit 11 movies. We've doubled the output of the film slate. When we first got here, we're on the iconic Paramount lot. This studio had 8 movies on the release calendar for this year. We're going to release 16 movies this year, and we've greenlit 11 films since we've been here. Cindy Holland has basically increased and greenlit 11 more original series to the P+ slate. We've added, as we talked about on our earnings call, over $1.5 billion basically to the P+ content budget, and that creates jobs. And I think when you really look at the alternative, which was this company was going to be sold, it was going to be sold to Netflix or it was going to be sold to us. Our deal is pro-competitive and good for the creator and good for creators. Basically, the creative ecosystem now has more places to sell and more scaled buyers, and consumers now have more choice.
Yeah, no, I understand the competitive argument, and it's one I'll be curious to see how the state AG feels. On that front, though, in terms of job losses, David, a lot of concern, certainly when you put CNN and CBS. Well, I don't want to say put them together, but I wonder, is that kind of part of the plan in terms of news gathering? And what do you tell employees of CNN at this point as they are concerned about their own future at that network?
So what I can tell you is we feel incredibly fortunate. CNN is an incredible brand with an incredible team, and we absolutely believe in the independence that needs to be maintained, obviously, for those incredible journalists, and we want to support that going forward. CNN and CBS News are brands that we also really want to be a part of transitioning to streaming, so that consumers have the choice. If they want to watch our incredible news brands on broadcast, they can do that. If they want to watch on cable, they can do that. But we also want to create a world where if they want to watch on streaming, they can do that, and where we can really meet consumers where they are. We're going to invest in the news business, and we think this transaction will be a positive for both CBS News and CNN.
You've said a number of times. Oh, sorry.
Sorry, go ahead. No, Julie, go ahead. I'm sorry.
You've just said a number of times that this is good for consumers, and you've also said that you're going to be merging Paramount Plus and HBO. There are a lot of questions about what that looks like and how much more you might be charging for this combined service. Can you give us any insight into what this is actually going to look like from a consumer standpoint?
No, absolutely. So I think, let's look at what we're offering versus what the alternative was, right? Because I think you have to actually compare what the two deals were on the table. One was Netflix that has 325 million subscribers, that if they had basically acquired WBD, would have been twice the size of the nearest competitor. With us, when you put basically HBO Max and Paramount Plus together, once you dedupe for the overlap, you're a little bit under 200 million subscribers. To contextualize, Disney's 195 million subscribers, Amazon's 200. That creates a healthier ecosystem. That gives consumers more choice in terms of what they want to pay for. It's going to be a significantly beneficial content offering that they're going to get. You're going to get Yellowstone, basically, and Game of Thrones on the same service. I think that's going to be pretty powerful. And again, for the creator economy, which I was a part of. I spent 15 years of my life selling to this ecosystem, and having another scaled buyer as a place where we want to grow, and our only way to obviously grow and to get to first place in streaming is to invest more in content. That's going to be good for the creator economy. It's going to be good for Hollywood.
But that didn't answer my question. Are you going to combine these two services and then raise the price of what people are paying for HBO, or what's the plan there?
So we're absolutely going to put the services together. We don't have anything to comment on pricing at this point.
Yeah, and then the other questions, you've mentioned technology a number of times. How big a role do you see AI playing in helping you bring down these costs as you look to manage that leverage?
So look, AI is here, and it's going to be, transformative across all aspects of the business. The way that we really look at artificial intelligence is really as a tool for artists. I do not believe that AI is a replacement for human creativity. I really view it as a force multiplier for basically filmmakers and the creative communities to be able to realize their visions more fully, and think it's going to be an incredibly powerful tool for this industry.
David, me again. Unfortunately, the world we live in has a political overlay on almost everything going on in the corporate world, certainly when it comes to news organizations. And there is certainly a perception and or a fear, perhaps, that once you take control of CNN and given the changes you've made at CBS, that you will be more beholden to the Trump administration. Can you address that, that potential fear, at least on the part of many?
Yeah, no, David. So look, I've said this since the beginning, which is, for when it really comes to editorial independence will absolutely be maintained. It's maintained at CBS. It'll be maintained at CNN. And really who we want to talk to is the 70% of Americans and really around the world that identify as center-left, that's center-right. And we want to be in the truth business. We want to be in the trust business. And that's not going to change.
And finally, David, for me at least, I mean, your father, Larry Ellison, your partners at Redbird, many others, I mean, your guys are putting up $47 billion in equity. And you're buying that at $16.02 a Paramount share, so above where the stock is right now. What can you tell our viewers in terms of your expectations for how this stock is going to perform, given all the challenges, obviously, Julie and I have just laid out for you?
Yeah, so David, just to level set, obviously the price was basically set by the Paramount independent directors that obviously work with third parties completely independent of us to basically determine and set the price. And we're the largest shareholder in Paramount. We're going to be the largest shareholder in the combined company. And, we're really dedicated to creating, long-term value for these businesses. And candidly, we couldn't be more optimistic about what we're going to be able to build here with these incredible companies.
Just finally wrapping up with a question about the legacy assets, because the big difference between your offer and Netflix's offer was that you were also buying the legacy linear assets, whereas Netflix was only interested in studio and streaming. We've seen Versant's stock, CNBC's parent company's stock, drop after it went public. Does that raise questions for you about the long-term value of these legacy assets, given the conversation about the difference between your offer and Netflix's offer?
So I don't think you can really look at the over. So again, a couple of pieces. One, there's a tremendous amount of cash flow that's obviously generated from those businesses, which we think is very advantageous. We can prolong the life of that linear business, given the synergies and given the combined portfolio. But really, when you look at the strength of the combined studios and streaming portfolio, this really puts us in a position to where we immediately get to scale in streaming. We have a creative content library that allows us to compete with the most scaled players in the business and really build the media company of the future, and we couldn't be more excited about what's ahead.
Well, fascinating new chapter for Hollywood, and we hope to continue having these conversations on our air. David Ellison, thank you so much for joining us here today.
Thank you for having me.
Guys, back over to you.
All right, Julia, our thanks to you. That's our Julia Borston. As you've been talking to David, there has been some erosion in the markets. S&P down almost a full % now. Oil's gotten close to 79. Every sector red except for energy, and we'll keep our eye on this. This would take you, these levels right here would take you back a little bit below yesterday's open. Let's get a CNBC News update with Dom Chu. Hey, Dom.
Launched a new wave of missiles at Israel today, and Israel said it began another wave of large-scale strikes on Tehran and struck Hezbollah command centers in Beirut as well. Meantime, Azerbaijan promised to respond to attacks by Iran on its territory, and Saudi Arabia and Qatar has said that they intercepted missiles and drones, so we'll keep an eye on that. Now, the Trump administration's first oil and gas lease sale in Alaska's Cook Inlet received no bids on Wednesday. That's according to the Interior Department. The offering was mandated under President Trump's tax and spending law passed last year. The lack of bids indicates reluctance by oil companies to explore in parts of Alaska, in part because of the higher costs. And Robinhood is launching a new credit card for wealthier customers in a bid to gain a foothold in an industry dominated by American Express and JP Morgan Chase. Called the Actual Platinum Card because it's plated with real platinum. It has an annual fee of $695 per year. Real precious metal card. Guys, I'll send things back over to you.
Okay, thank you, Dom. After the break, why Salesforce CEO Mark Benioff says AI adoption does not mean fewer jobs. Plus, Broadcom, latest name to get a big AI boost. We'll have details on the CEO's staggering demand forecast when we come right back. Stock's up more than 3%. Welcome back. Watching software names. They're rebounding from their worst levels of the year after selling off in all sorts of AI disruption concerns. Salesforce, ServiceNow, Workday, all seeing nice pops today, though they're still down more than 20% year to date. I spoke exclusively with Salesforce CEO Mark Benioff last night. We started talking about those disruption fears and what he thinks the market has wrong.
The software industry is going to radically expand in terms of its capability and size and scale. And there's just no two ways about that. Of course, we all know SaaS and SaaS apps, and that's all about managing humans. And now we have a whole new generation of the software industry that's getting unleashed, which is what we call this agent economy. And that's why we built Agentforce over the last 3 years, because we've seen this coming. And that's a huge extension to the software industry. So for example, Sarah, in sales, I have 15,000 salespeople. And now each one of them is harnessed by hundreds of agents that are qualifying leads for them and calling customers and figuring out how to quote. And that kind of productivity enhancement, that's what we've always wanted in software.
So my question is, does Claude, for instance, Claude Cowork, directly compete with that ability to do customer service or commerce and all the other services you do for your enterprise customers?
Well, we use Claude, and we also use OpenAI, and we use Gemini. In fact, we use all the models to extend our products. It's really at the very core of our platform now. And then, of course, we have a huge data business. It's a $10 billion a year business that's helping our customers federate and also integrate and harmonize their data. And then, of course, we have our amazing apps, like our sales app or service app or Slack. And then we have Agentforce, like you mentioned. And then we have this incredible collaborative interface with customer agents and employee agents. And that's the modern software stack. And yes, we have more to sell to customers than ever. And we have more to use internally than ever. We have 83,000 employees now, Sarah. That's the most we've ever had. And it's not that I haven't adjusted slightly some of our units in terms of who has the most, capability, because I'm able to automate some areas using AI. But in the vast majority of functions in the company, I've needed to grow our revenue, to grow our bookings, to grow our margins.
I was going to ask if you've been growing your own workforce and where you're hiring, because you're also rethinking the business model, right? And trying to grow the AI services and Agentforce. So how disruptive is that for your own
100% right.
workforce?
Oh, and especially here in the United States, it's just an incredible economy. And also Japan and a lot of amazing countries are still growing really aggressively. And that's where we're fueling the growth. But not just countries. We also, Sarah, we sell to small businesses, to medium, very large businesses, the government, ISVs. All of those segments are growing. Some of them are growing faster than others. I will say that. I've talked about that on the earnings call. You probably heard that. But I would say that, wow, we have a huge opportunity to sell apps and agents to every customer today.
I keep bringing up Anthropic because that's the one where every time Claude does some sort of update on what they're working on and some advancement, it sort of syncs all the software stocks. But interestingly, Salesforce owns a chunk of Anthropic, and you've participated in several rounds of fundraising. So it would be ironic if you thought that they were going to come after your business.
We're obviously huge fans of the company, of the CEO, of his sister, Daniela. They've done an amazing job, brother and sister team, unprecedented in our industry. You are right. We've invested more than $330 million in Anthropic over the last 5 rounds. And look, we're very bullish on AI as a huge transformational agent for the whole software industry. And, like I was saying before, Sarah, look, the software industry has been a lot about apps for the last, call it, 40 years. Salesforce is now 27 years old. March 8th, 1999 is when we started Salesforce. Now, all of a sudden, we can not only are selling apps, but we're selling agents as well. That's a huge opportunity for us. And those agents are all driven by those models. And I will also say we make a lot of our own models as well. So we power a lot of our own agent technology as well.
And then just back to the market, Mark, because it's been so ugly for those in your sector. I know you've been sort of a poster child of this SaaS model, but a lot of these software stocks have gotten beaten up hard. Does it present opportunities for you for M&A?
Well, we have a very disciplined M&A strategy. A lot of those companies have slipped into our, zone because, when you're looking for great values, I think there's a lot of great values out there. And look, the number one great value from our perspective remains Salesforce, which is, why we have kind of put together this idea that we're going to buy back more Salesforce stock than ever. We're so excited about that opportunity. There's no question that there's a narrative in the market around the SaaSpocalypse. And we are, yes, the number one SaaS company. So we've unleashed our Sasquatch. And we told it to go eat the SaaSpocalypse because we want to buy back stock. We want to look around for great values. We increased our dividend as well. I mean, we're going to deliver more than $16.5 billion in cash flow this year. We want to return that to our investors in smart ways. There's so many exciting things for us to do.
But you have confidence in your own business. I wonder if you think there are any parts of the group that might be more in trouble, that don't do what you do.
Well, like you, Sarah, I follow the software industry very closely. I have watched a lot of these amazing companies deliver fantastic results and their stocks go down. I have been shocked. And in security, whether it's small business, whether it's in my own part of the sector in CRM, whether it's in collaboration like Slack, I'm following hundreds of stocks myself. And I can't really understand it. I don't understand why all of a sudden you get to a perspective where revenue doesn't matter, margin doesn't matter, RPO doesn't matter, cash flow doesn't matter. When those things are happening, that's when you know there must be a major dislocation. Those are the signs when something is wrong, because we know that the stock market always will go back to fundamentals. And these companies, including ours, have tremendous customer bases, huge intellectual property, great brands, advocates inside these companies that are rooting for them. And they are automating the core parts of business globally. And so just to say that they're all worth less because of some potential of AI in the future, I think is inappropriate. And I think that the market has gotten dislocated from the fundamentals. That's all.
And then we went on to have a little back and forth about how the robots are not opening doors, the robots are not self-aware, the robots are not anchoring CNBC yet. We hope that doesn't happen. But basically that was his full-throated defense for both his company and I think the entire industry, where he said there's a lot of companies that look very cheap. He's putting his money where his mouth is, $50 billion stock buyback on that point. But ultimately that he doesn't see the SaaSpocalypse in the numbers. He doesn't see it in the pipeline. He doesn't see it in the business, and he thinks it's a fantasy and really compares it to the movies when you hear people thinking that AI is just going to take over everything that they built and do on a human scale for their customers. I mean, they don't have the history, they don't have the intellectual property, they don't have the licenses. You know, he goes on and on and on, and just says it's totally disconnected from the fundamentals.
Yeah, the industry's starting to get its story together, so to speak. I feel like we're starting to get a better full-throated response to this so-called SaaSpocalypse and what's happened to the stock prices. And it starts with, you know, mission critical and proprietary data, and you can't rip these things out, and outcome-based as opposed to seat-based. But obviously, none of us know, right, Sarah?
Yeah,
and nobody, we really, I mean, because the technology is not static. AI continues to move forward and improve itself very quickly. But these are all important things, and will it be the companies like Salesforce that use the technology on behalf of their clients, or will their clients?
Right.
And I do wonder about pricing. That's one thing. Like,
Yes,
are the clients going to start to say, well, I could use Claude and then get a price reduction?
Right, that's the question about the SaaS model, right? Are they going to have the pricing power? Are they going to have the moat that they always had where they were able to make it as good of a business? And maybe that just means that the stocks get cheaper, but, you know, not extinct as some of the worst case. But I think his point is just like there's a lot of imagination here at this point, because we don't know, and it does not stack it up with what he's seeing. And he feels that he's been on the forefront of the AI story, boosting their business, not the other way around. They saw an acceleration in revenues this quarter.
It definitely has gotten cheaper, although IGV is almost green for the month to date. Pretty nice bounce here going back to the second day of February, I think. Still ahead, a lot more on AI disruption when we're joined by Oaktree's co-chair Howard Marks. We'll break down the one job category that he says is safe from AI replacement.
Still to come, the CEO of Okta breaking down results as shares gain despite half a dozen firms cutting their price targets this morning. We'll talk about what some of the worries are, with the stock up almost 9%. Getting comments from OpenAI Sam Altman as well. We're going to cover that for you as well when we come right back.
Getting some breaking news on OpenAI and some new comments from Sam Altman. For that, we'll turn to Kate Rooney. Morning, Kate.
Hi, guys. Good morning. So Sam Altman, the OpenAI CEO, just got off stage here at the Morgan Stanley conference. He did address some of the controversy around OpenAI's Pentagon contract, insisting that they, quote, did not rush into that deal with the U.S. government, and then taking some subtle jabs at rival Anthropic. Didn't mention them by name, but says because some people, quote, don't like the person or people currently in charge, that is challenged no matter what. Says he thinks it's bad for society. That, of course, a nod to some reports that Anthropic CEO Dario Amodei did criticize Altman's relationship with the administration and called it, in a leaked memo, dictator-style praise to Trump. Again, that's according to the information and reports there. Altman went on to say, quote, the government is supposed to be more powerful than private companies. Did also say that the Department of Defense understood the need for safety, where some of the AI technology just isn't ready yet. He said there are times when the legal system has not caught up with any of the technology, mentioned the red lines we've talked about and what's in their contract. Said they think the legal system is going to need to catch up. Again, the technology says just currently not safe enough in certain instances. The law is going to have to evolve fast for many reasons beyond just the government in this particular instance. Also touting some of the recent growth in coding agents. That product, which is known as Codex, he says, growing more than 25% per week, 2 million users now. Those numbers are new. And Altman did not discuss this on stage, but I am hearing from a source, it's $25 billion in recurring revenue, ARR there. And then you've also got Anthropic, we reported yesterday, closer to $19 billion. So some pretty strong momentum there on the revenue numbers. But that's the latest from Altman, guys.
Yeah. Kate, so interesting to watch these two go back and forth, obviously, Amodei in particular. But back to the sort of OpenAI side, going public. Jensen Huang made comments that seemed to indicate he expects them to go public this year. Do we hear anything from Altman on that?
You know, that's sort of the subtle backdrop here, David. You know, it's Morgan Stanley's conference. There's a ton of bankers in the room. They did not mention any sort of IPO timeline, but it's expected from what I'm hearing within the year. It could be later, could be at the end of this year, but I am hearing that they're preparing. They're doing the work behind the scenes to get IPO ready. But, you know, at a conference like this, you got to expect that one big reason they're here is to talk to bankers, also on the Morgan Stanley side, sort of courting that business and wanting to take that company public. But we didn't get that. We talked about they talked about rather the $110 billion fundraise on Friday, some of the strategics involved, and that was another topic of conversation, kind of how this all plays out, what it looks like, but nothing specific on an IPO timeline, although I think everybody in the audience would have raised their hand and asked that.
I feel like the context is key, right? They used to work together at OpenAI, and Amodei left to form Anthropic because he was worried about security issues. So it is interesting that that's where the fight here is with the Department of War over the sort of ethos of the company and these security issues. Do we know whether Altman signed the same terms that Anthropic shot down when it came to working with the Pentagon?
It's a great point, Sarah, about some of the backdrop here. A lot of the Anthropic founders were originally OpenAI, so this has been a subtle rivalry that's now spilled into the open. On the contract side, the criticism for OpenAI is that Altman had agreed to what Anthropic said no to, and safety advocates saying, you know, why would you accept a deal that Anthropic would not? We don't know exactly what's in the contract, although Altman has said we have red lines, we have technical safeguards in place. But I think that is one of the debates right now of exactly what's in that contract.
Yeah.
Second day in a row of some important headlines coming out of your city there in San Francisco. Kate, thank you, Kate Rooney. After the break, an exclusive with Oaktree's Howard Marks as Money Movers begins.
Thursday morning. Welcome to Money Movers. I'm Sarah Eisen with Carl Quintanilla, live from Post 9 of the New York Stock Exchange. Today, legendary investor Howard Marks is with us. We'll get his take on the macro impact of the Iran war, fears in the private credit market, concerns about an AI bubble, and more.
Plus, after the SaaS Coppola fear-fueled sell-off, momentum in AI agents driving an earnings beat for Okta, but the guidance still signals some pressures ahead. We'll break it down with CEO Todd McKinnon this hour.
And we are watching the chips. Shares of Broadcom on the move. CEO Hock Tan saying he sees AI chip revenue significantly above $100 billion next year.
As for the markets, Dow down about 1.5% here, trying to hold 6,800 on the S&P, which we just bounced off of a couple of moments ago. Breadth is still relatively negative 3-1. Tech and energy doing most of the water carrying today. And the 10-year got close to 415, backing off maybe a basis point or two.
Unusual day. Salesforce, IBM leading the Dow right now. Let's start with the market. AI uncertainty still at the forefront. Our next guest exploring the AI hurdles ahead in his latest memo amid layoffs and rapid CapEx expansion. Here with us now at Post 9 is Oaktree Capital co-chairman, co-founder Howard Marks. Welcome back. Lovely to have you.
Thank you, Sarah. Thank you, Carl.
You really went deep on Claude for your last memo.
I did. I went deep with Claude.
With Claude. And what did you glean from that experience?
Well, I was, as I wrote in the memo, I was blown away by my experience. My son and some of his young colleagues suggested that I consult Claude for a tutorial on AI, and what I got back was incredible and really opened my eyes, and I suggested everybody get personal with Claude.
But
some
Claude
version
can't
of
do
AI.
the memos, right? That's Howard Marks.
Well, let's hope not, because otherwise, you know, I won't be seeing you in the future. I don't think so. I think it can do certain things great and better than any human. I like to believe there are some things that the best of humans will be able to do better. Not all humans, but hopefully the best.
Did it give you any insights into valuations and how you think about investing around this theme?
No, not valuations. That's too granular, and I don't know if Claude has any idea what he should sell for. but you know, what I explored is what it can do and what it can't do, and the point is that every day I think it can do more than it could the day before, even to the point where OpenAI brought out a new model, and in the descriptive materials they said that the model helped build the model, which is really eye-opening. But I think it's important to know the powers and the limitations.
Big picture, we keep hearing some people say technology always brings new cycles of employment. Mm-hmm. Others argue this is a replacement for overall cognitive work, and you may try to retrain, but it's also trying to replace that where you're going to retrain.
Well, I thank you for framing it that way, Carl. I think that's the debate. I say in the memo that I am not enough of an optimist or a futurist to be able to be confident where the jobs are going to come from. Clearly, it can eliminate a huge percentage of knowledge work. And we saw Friday, Block, 10,000 employees, let 40%, 4,000 people let go in one go, who aren't needed anymore because AI can do it better and cheaper and faster. And so one day, 4,000 people lose their jobs. It'll probably take them on average 6 to 12 months to get a new job, hopefully they can. So one of my concerns is that AI moves faster than the ability of society to adjust to it. And that is a formula for disruption.
Right. And then on prices, if the value of information or the cost of information goes to zero, and that's a huge disinflationary effect, isn't it?
I am very guarded on the ability to figure out what the implications are. You know, I think it was Walter Cronkite who said, if you're not confused, you don't know what's going on. I would say if you think you know what's going to happen, you don't understand what's going on. We're in the first inning of a very long, unpredictable game. We don't know what the rules are or have any idea how many innings there are in the game.
Or how everyone else is going to react.
Exactly,
right?
exactly.
We do know that some of the software sector has gotten really beat up
Yes.
on concerns about this, and I was going to ask you if any of these software loans look interesting to you.
Well, you know, I mean, Oaktree, my firm, is built. I was lucky. I got asked to start a high-yield bond fund at Citibank 48 years ago, which was the beginning of that world. And, you know, everything we do and have done is premised on the belief that at the right price, almost anything is a buy. I learned through my experience in the decade before that, my involvement in the Nifty 50 equities, that at the wrong price, everything's a disaster. So it's all price, and you know, we have to talk about individual loans in the software sector, the resilience of the companies, the stickiness of the revenue streams, the ability to replace the product, and then we can start talking about the right price for the debt.
But you are having those conversations, clearly.
Of course,
yeah.
of course. You know, when I mentioned in a minute ago that what we're seeing, the end product is disruption. We thrive on disruption. When nothing's disrupted and everything's placid and everybody's optimistic and nobody wants to disgorge their holdings, we have a tough time finding interesting situations. That's not the case anymore.
Yeah, I spoke to Mark Benioff, and he said a moment ago that he sees major dislocation,
Yes.
obviously, when it comes to the fundamentals of these businesses and what the market is telling us. Sounds like you agree.
Well, absolutely. I mean, I think my perception is that AI has the ability to be the most disruptive, dislocating force the world has ever seen. I mean, I say in the memo that the past technological innovations, the railroad, the radio, the car, factory automation, the computer, the internet, these were labor-saving devices that made the tasks we were doing easier.
Mm-hmm.
In this case, number one, AI can probably figure out a way to perform tasks we aren't doing and haven't even thought of. And number two, to take them on itself without instruction. So this is really revolutionary.
One popular game right now, it's not as big as the societal things you're mentioning just a moment ago, are software default rates, right? And whether or not they go to 15, and some say that's an irresponsible thing to say, others say it's almost certain. How do you approach that question?
I couldn't put a number on that, and I don't know enough about the sector overall. And as I say, these things are just beginning to happen. So it doesn't matter what the aggregate is. We are what are called bottom-up investors, and we don't reach a theory on the economy, the market, the industry, the sector. We study each company individually, and we look at its own merits,
But to Carl's point, there are concerns now. I mean, it's the latest hiccup in the private credit trade, and we see that in a lot of these, managers that are trading, and that is how much software exposure do they have,
right,
and what happens ultimately to that credit.
This is going to be, look, the job of the credit investor is very simple: to figure out the probability of default and to figure out whether the promised yield is compensatory. That's all. It's a one-dimension analysis. The poor equity analyst has to also think about, well, what's the probability that it'll thrive, or that it'll double, or could it quadruple, or maybe octuple? We only have to figure out whether it's going to pay, and whether the probability that it pays, and whether the yield that's offered is sufficient to compensate for that risk.
But does Oaktree have some of these exposures and also some of these other issues that the private credit industry is dealing with that we read about every single day?
Well, I mean, we certainly have some software holdings. I think we have probably much less than most. We didn't swell our assets, so we weren't under pressure to put inordinate amounts of money to work quickly. So I think that permits you to be more discriminatory. Chuck Prince at Citi said in '07, when the music's playing, you have to dance. When you don't have enormous sums of money coming in the door every day, you don't have the pressure to dance, and you can sit out when you think you should.
Right.
But in the investment world, success is not doing all the good things and none of the bad things. It's doing more of the good things than most other people and less of the bad things. I can't imagine there's a private credit investor out there who doesn't own any software. The only question is how much, and is it the companies that are more affected or the companies that are less affected?
What about the broader concerns around private credit right now? Not just software, but also, redemption requests, concerns around certain funds with that. There were the cockroaches that Jamie Dimon mentioned, some of the bankruptcies,
right.
Loose standards. How risky is private credit right now?
When I came into the exchange this morning, I said to the guys at the security desk, have you read the book 1929? Andrew Ross Sorkin's book about the Great Crash.
Yeah.
And I said, because the epicenter was across the street at 23 Wall, JP Morgan headquarters. And Andrew does a great job of describing what led up to it and what resulted, and sums up beautifully in his afterword. And he says the lesson to be taken away is, how carefree, how optimistic do you get, how carefree do you behave when everything's going well, because that is what determines your ability to survive when things go poorly, as they eventually will. By the way, when things are going well, everybody says it's different this time. There's never going to be another recession. There's never going to be another correction or crash or what have you. And there always is, because they're brought about not by physical developments, but by investor psychology and its excesses. So I think that we had 17 good years. March 2009, maybe 17 years ago today or tomorrow,
pretty close.
was the low point of the market in the global financial crisis. Since then, 17 years, essentially 17 good years. When you have long periods like that, optimism rises to new highs, and people stop worrying about what could go wrong. Fear of missing out takes over from fear of losing money, and speed of execution and amount of assets takes over from discernment and discipline, and bad things happen. There's a saying in the banking business that the worst of loans are made in the best of times. We've seen 17 years of good times. Don't you think that's going to encourage some bad loans?
Yes.
And so when the stuff hits the fan, or as Warren Buffett would say, when the tide goes out, we will find out whose credit analysis was discerning, who made fewer software loans to the better companies. And so, there's not a systemic problem with private credit. There's only the fact that the 17 good years and the massive growth of direct lending from essentially inception in 2011 to well over $1 trillion today, took place at a headlong pace. Mm-hmm. Was it done carefully or not?
And you think we're going to find out?
Well, I know we're going to find out.
I guess the question is when. I mean, usually that happens when you get a tightening cycle or something with the Fed. It doesn't appear that we're on the brink of that.
You know
Maybe,
what?
But it doesn't seem that
Sarah,
way.
one of my most frequent rejoinders is, in the investment world, we sometimes know what's going to happen. We never know when. So any question that starts with when, you can forget about answering. And, 3 months ago, nobody conceived of what went on in software. And if you would have said to somebody 3 months ago, when will we have, the first crack, or 9 months ago, First Brands and Tricolor, and you would have said, when will we have the first crack? People would say, well, I don't see anything on the horizon. I know it's coming, but I don't see anything. And then, bang, it happens. And the things that affect the investment world so profoundly are the things that were not foreseen. If they could be foreseen and anticipated and adjusted to and factored into prices, they wouldn't have that cataclysmic effect.
Finally, it seems wrong not to ask you about either your choice, sort of the CapEx cycle that we're in, or the war. Which one are you spending more time thinking about?
Well, I can't spend much time thinking about the war from an investment point of view because I have no idea what's going to happen, and this is not predictable. So I don't think there's anything intelligent for investors to do in reaction to the war except to not be Pollyanna and not be suicidal. Both of those things usually fail to work. What was my other choice? CapEx. Well, CapEx is going to continue, and most of it is being engaged in by the hyperscalers, and they can probably afford it. Although they're going to go from doing it from cash in the bank to current operating to cash flow to borrowing, and that will increase the riskiness of the system and also themselves. But probably they're such great companies, they're probably not going to screw that up. And then. But the companies that aren't hyperscalers that are engaging in it, these are going to be sink or swim situations. But the companies that can afford to do it right now, like OpenAI and so forth, great companies, hard to bet against. And I'm glad I'm not in the business of buying tech equities.
Well, Howard, it was a pleasure having you. Always.
Thank you.
Getting to hear from you.
It's always great to be here.
On the memos and beyond. Your investing philosophy. Howard Marks, co-founder of Oaktree. Thank you.
Still to come this morning, we'll get Cowen's first reaction to Broadcom last night. Just how much they think this AI boom can help sales. Elsewhere in chips, Meta, NVIDIA with some news of their own today.
Plus, we are watching this move lower in the Dow. We're going to take a look at what is dragging the index down today. S&P, it looks like now down almost 1%. Why Salesforce is bucking the trend. You'll hear from Mark Benioff. Money Movers will be right back.
Shares of Broadcom in the green today, and a pretty tough tape here on the back of quarterly results. Our Christina Partsinevelos has a look at how the report was different from NVIDIA's, KP.
Yeah, Carl, you're seeing shares up about 5%, and the reason really comes down to what CEO Hock Tan delivered on the call last night. Not just a strong quarter, but really a convincing argument for why this growth lasts. That's exactly what the market didn't necessarily get for NVIDIA last week when a near-perfect report still sent the stock down. There's just still a lot of questions about the upside over the next several years for NVIDIA. Broadcom's AI revenue more than doubled. Their software business won't be negatively impacted by AI, according to the CEO. And he also gave investors a line of sight to more than $100 billion in AI chip revenue in 2027. So that's well above what even the most bullish analysts had modeled. Two things specifically move the needle for this share price. First, margins. Investors had been worried that as Broadcom ships more AI racks, which is the physical systems that house these chips, those products would drag down profitability. Hock Tan, the CEO, said last night that's no longer the case. Second, customer-owned tooling, which is the risk that hyperscalers like Google start designing their own chips completely and cut Broadcom out. Hock Tan pushed back hard, saying the complexity of competing with NVIDIA makes that nearly impossible for years to come. He did say years to come. OpenAI was also confirmed as a sixth customer, and they said they locked in memory supply through 2028. That's the first time I've heard any company say that far ahead. The move is definitely rippling through some related names. Credo is up, you can see, about 10%. Amphenol up about 3% right now. Both those names benefiting from Broadcom's signal that customers still prefer copper connectivity over newer optical technology that links all of these AI servers together. That's their business. Lumentum and Coherent, on the other hand, which are betting that newer optical technology will be the driver, are both down just based off of that same commentary from Hock Tan. Guys?
A great setup for our next conversation. Christina, thank you. Christina Partsinevelos. For more, let's bring in TD Cowen analyst Josh Buchalter has a buy rating on the stock. Josh, it's good to see you. To Christina's point, you point out that copper is kind of a hero in this backdrop.
Yeah, thank you for having me on. I think it was surprising, and there's been a lot of narrative in favor of optical recently. There's also expectations coming out with GTC and OFC coming up soon that there's going to be a lot of narrative positivity on optical. But I think Hock and Broadcom felt the need to sort of gives a more realistic view of the slope of that and say that Hopper's going to last for longer. I think he called out 2 generations specifically, which brings copper, keeping the copper alive and well, at least through most of the rest of the decade. So yeah, it was definitely a change in the sentiment.
Right. Overall, though, his commentary, I assume you found reassuring.
Yeah, I mean, certainly bigger picture to Broadcom. I think, as Christina was just pointing out, he leaned in hard to the visibility angle, and specifically on 2027, talking to that greater than $100 billion number. I thought it was also very interesting. I mean, he was name dropping customers. He gave specific gigawatt numbers for several of them. And then, as Christina was pointing out, leaning into both the supply and demand durability, lasting beyond that greater than $100 billion number in 2027 into 2028. I would also be remiss to not point out, if you take some of the metrics they've given previously on the revenue per gigawatt metrics and simply add up the gigawatts he was talking about, which, by the way, didn't include TPU, I mean, it puts up some decent numbers well above $100 billion for next year. I think what the market's going to struggle with is how much to discount that and how much upside they should be putting into their models today, given some of these are newer programs.
Yeah, that's what I was going to ask, is just how the market is dealing with these stocks. They're up today 5% Broadcom, but they've been stuck this year. Mm-hmm. It's still a stock that's 20% off the highs, and it's like these demand forecasts get more bullish. Same thing with NVIDIA. What is the problem that the market has with these companies, and is it the ability to do this forever? Is it the valuations? Like, what's the hesitation here?
Yeah, it's a really good question, and one I wish, frankly, I had the answer to. On one hand, I think perspective is very important here. Like, yes, the stocks haven't had a great 3 or 4 months, but they've been some of the best performers over the last, or really the best performers over the last several years. I think it's a question of convincing people of the durability and visibility into CapEx and the spending environment. I think, Mr. Markson previously put out a compelling case of why where the sources of funding are going to be more durable. I think the companies are putting out some compelling arguments that the number of applications using AI, the complexity of those applications, and the numbers of users are all going up at the same time, which puts an immense amount of demand and strain on the compute backdrop. But I think part of the problem is also that these companies have gotten so big that it's a lot of non-semiconductor investors that are trafficking in these names also that frankly I think need more convincing than a core semis investor.
Right, right. To that point, kind of, I wonder, Josh, if you think the whole semi versus software debate is still alive in that it's sort of zero sum, and if sentiment improves in software, that it's somehow a liability for chips.
Yeah, it's a good question, and I don't cover software, so I'm hesitant to really tread into that vertical specifically. But I would note, it is interesting to me, and it doesn't necessarily make sense that the semis compute vendors have sort of traded flat at a time when software has sold off so massively because of the fact that there's worries about disruption from companies and coding that is built upon semiconductors.
Yeah, exactly.
So, I think the debate is alive and well is a short answer.
Yeah, that's for sure.
Both working today.
Yeah. Josh, thanks. Good stuff.
Thank you for having me.
Speaking of, later this hour, structural shift for software. NVIDIA's Jensen Huang laying out a new vision for the future of the internet, and it could redefine who the winners and losers are.
Speaking of software, an exclusive with the CEO of Okta today. Stocks higher on the back of results, again, bucking the downtrend that we have seen so far this year. We're back in a moment. Let's get a CNBC News update with Leslie Picker. Morning, Leslie.
Hey, good morning, Carl. Democratic Senators Jeff Merkley and Amy Klobuchar are reportedly introducing legislation today to ban the president, vice president, and members of Congress from trading event contracts in the prediction markets. According to NBC News, the bill would also limit prediction market activity for senior executive branch officials and impose fines starting at $10,000. Legendary college football coach Lou Holtz has died. Holtz coached at 6 schools during his career and led Notre Dame to a national championship in 1988. After retiring from coaching, Holtz worked in TV, including a decade with ESPN. According to a statement released by Notre Dame, Holtz died in Orlando, surrounded by family. He was 89 years old. And a classic TV house just got landmark status. You recognize it? The LA City Council voted unanimously Wednesday to designate the so-called Brady Bunch house as a historic cultural monument. The exterior of the house in the San Fernando Valley was used for the iconic series. Landmark status for the home makes it difficult to do any demolition or major renovation. Kind of surprised it didn't already have it, but yes, an iconic house indeed, guys.
Oh, yes, I recognized it.
Big Brady Bunch fan, yes.
Yes, if you watched, you know that house. Thank you, Leslie.
I agree.
Leslie Picker, still ahead. Salesforce top gainer on the Dow today as the index falls by more than 1.5%. We'll bring you some new comments from Salesforce CEO Mark Benioff on the so-called SaaSpocalypse.
Keeping an eye on oil today, obviously, continuing to rise as the Iran conflict drags on. WTI came within about 50 cents of an 8 handle. That would be the highest level since January of last year. We're back in a moment.
Welcome back. Dow's under pressure this morning, down about almost 800 points right now. Some of the biggest losers, consumer names, Walmart falling about 4%. On the other hand, Salesforce is the biggest winner right now. I spoke with CEO Mark Benioff about some of the software fears that have been out there in the market. Here's what he said.
You can do more with AI, and our customers are doing more with AI. But to say that there's some kind of a SaaS apocalypse going on, well, we don't see it in our pipelines, and we don't see it in our numbers.
And that was the headline. I mean, that's what he really wanted to convey. For more on what's moving under the surface, let's bring in CNBC Markets commentator Mike Santoli. Do you think that the market is coming to terms with what Benioff is saying?
Look, it might be. I think that what really is happening is Walmart was basically the best performing defensive name year to date. Salesforce was among the worst. And I do think people have gotten a little more comfort in let's slow down and let's actually look at the business models and let's try to figure out exactly when, it might get tougher and margins might get squeezed. But I think that the big rule, even last week, the IGV or even the week before, the software ETF kind of bottomed on massive volume, and then it was a matter of do we actually believe the bounce? Where are we selling the bounce? I think it's fascinating how much whipsaw action the events of the weekend and the uptick in volatility has triggered. So you basically have the worst performing year-to-date stocks in the S&P 500 are up 5% this week on average in a week when the S&P is down 3.5%. So the rest of the world was outperforming the U.S. The rest of the world is underperforming the U.S. on a week-to-date basis by 2x. So the point is, it triggered just this massive, we're bringing risk down. What does risk mean? Well, we sell the momentum winners, and we buy the stuff we hated and was most shorted. And exactly, and the Kospi and the memory stocks and all the rest of it. So I don't know that that's going to be the rule from here on, but I think it's contributing to this sense of kind of erratic internal action. We're trying to hold the lower end of the range here, 6,800 on the S&P. The VIX doesn't believe that there's anything in terms of clarity right now, but I do think that we've priced ourselves to be open to the possibility that this is a short and contained event, and it's not necessarily like you want to walk away from it. Everybody came into the week pretty well understanding that these types of things tend to present buying opportunities. Ultimately, they don't end bull markets. But that doesn't mean you buy the opening tick on Monday, get an immediate intraday rally, reload 1% lower at 10:30 a.m. on Tuesday, and it's up and away from there. Because that's what it would be. If we go back toward the highs, that would be the way that trade played out.
The other confusing element, we mentioned this with Jim this morning, are some of these online travel agents leading the S&P on a morning where you would imagine tourism takes a hit. You pointed to a couple of different
I think that's much more about they were in the penalty box because AI was going to kill them along with the rest of software, and now there may be a little bit of relief, the sense that OpenAI might not be trying to do it itself. So it's really hard to look through it and get a macro message, except for airlines down 11% this week. I mean, the market's trying to limit the damage to the areas that seem very, very specifically impacted. I think it's a buffer that the economic data have been good. Earnings obviously did what they had to do. So it's not as if we're having a macro panic, although financial conditions have tightened. Yields up, dollar up, oil up, VIX up. That means financial conditions.
And all those things are, interestingly, oil up, dollar up, yields up, all still playing out today.
That's right.
That presents a risk ultimately, right?
It does. I mean, whether that's just kind of going to be an offset to some of the tailwinds, or it presents something where the financial markets find it gets to a level where the equity indexes can't hold their range. That much we'll see. But I do think that again, we certainly accounted for some of the potential impact, but have tried to keep one hand in this might be fine, and we might be looking back on this as a passing storm.
Okay, Mike, thank you for summarizing it always very eloquently. Up next, an exclusive with the CEO of Okta on the back of Q4 results. Stock getting caught up in the software sell-off to start the year, but bucking the trend certainly this morning, up 9%. We'll be right back.
Welcome back. Take a look at shares of Okta today. The identity security firm climbing after reporting a beat on the top and the bottom line for Q4. Full year guidance above consensus. Says AI is, quote, redefining the future of software, especially when it comes to securing AI agents. Joining us this morning in a CNBC exclusive is Okta's co-founder and CEO, Todd McKinnon. Todd, welcome back. As always, good to have you.
Thanks for having me, Carl.
Sarah and I were just talking during the break about how the timing of your quarter is happening in a moment where at least the street is open to arguments about the longevity of software.
There's definitely a lot of debate out there. And when we look at it, to put it lightly, yeah, when we look at it, there's a couple of things that are unassailably true. In 5 years, technology is going to be much bigger than it is today. And it's because the opportunity is vast. If you think at technology automation and how we can automate things with this new AI technology and how we can make people more productive, and in cases we can do tasks that people would have done by themselves in an automated way, technology will be far, far bigger. And I think one of the things people get wrong when they're thinking through this debate is they think it's zero sum. They think that if, you know, Anthropic is going to win, then Salesforce is going to lose. It's not zero sum at all. The reality is there will be change and disruption, but everyone has the opportunity to be much bigger and grow fast and take advantage of all this stuff. And I think when we talk to our customers, that's what they're trying to sort through as well.
Can you kind of describe what a client is asking you about how you secure an agent?
Well, first of all, they're very excited and they see the opportunity, but they're inundated with choices, and everyone has an agent, and there's agent platforms from all the big vendors, and they're thinking about building their own agents, and everyone agrees that the future is agentic. So software is going to just turn into agentic, meaning every piece of software is going to do things on its own, act autonomously, do long-running tasks, and there'll be new solutions and old solutions will be upgraded. So customers are trying to figure all that out, and they need an identity system that can keep track of it all. They need to know which agents are allowed to be used by which people. They need to know which agents can run on their own, and most importantly, they need to know, and this is critical to understand, they need to know what data the agents can connect to. Can it go to Salesforce? Can it go to their own custom database? Can it go to Databricks or Snowflake? And that's what we do. We keep track of the agents across any platform, whether you get it from Salesforce or Microsoft or Amazon or Google, and we keep track of what it can connect to, because these agents are only as valuable as the information they can pull in about your company. If they don't know about your company, it's not as useful as if it does, and it's just like a generic chatbot. So those connections are super valuable to customers.
So are you more threatened right now in a competitive way by, I wonder, some of the more traditional cyber players like a CrowdStrike or Palo Alto that are getting into identity security more?
The prize is massive. I think what's happened over the last couple of years is the total addressable market for identity is really ballooned, and it could be the biggest thing in cyber. Eventually it could be bigger than all of cyber. Think about what's at stake here. It's the fabric and the infrastructure, how all of agentic technology is connected to all the data sources. That's incredibly valuable for customers. So the prize is massive. So in a sense, I mean, every big platform, everyone's going to want to compete for this massive prize, and we think we're in a good position because we've spent 17 years figuring out what people can connect to and securing those connections. And agents are different than people, but there's a lot of similarities, and we can take that expertise and apply it to this new world. And it's resonating with customers. 30% of our bookings in the last quarter, we just reported Q4, were from our new products, and in there are our Okta for AI Agents product and our Auth0 for AI Agents product. So it's resonating with customers.
So just to reiterate, Gen AI does what to your business? And when?
It expands the TAM massively. It makes identity more relevant. It makes the identity layer and the identity infrastructure rails for this agentic future a massive opportunity for us, and we're very focused on working hard and executing on capturing it.
So when the street is now thinking about sub-revenue growth rates, what's a benchmark? What's reasonable? What's aspirational? What's a disappointment?
Well, we think that we just issued our guidance for this fiscal year. And we think we've got to remember that this is a multi-year, if not decade, process of rolling out these agents and upgrading the tech stacks and innovation. So when you give guidance for 1 year, you have to be prudent. But over a number of years, we're very excited about massively accelerating growth and seizing this opportunity in front of us. It's going to be exciting, and we're working hard to capture it.
Todd, appreciate it. Obviously, as you said, so much debate going on and amid a swirl of headlines, but it's good to get your take, as always. Thanks. Todd McKinnon at Okta.
Yeah, big move. Stock moving higher even more now, up more than 10%. When we come back, a structural shift for software. A lot of software talk today. NVIDIA's Jensen Huang laying out a new vision for the future of the internet where people aren't the primary users, and it could redefine the winners and losers. We're on top of that story next. NVIDIA CEO Jensen Huang talking up the importance of the AI agent platform OpenClaw yesterday, calling it, quote, the single most important release of software probably ever. Deirdre Bosa has more in today's Tech Check. So what are the implications of this, Deirdre?
Well, first of all, Sarah, make no mistake, Jensen Huang is certainly talking his book here. Chatbot is one question, one answer, but an agent runs autonomously 1 million times more tokens, as he put it. So more compute, more chips, more NVIDIA revenue. But beyond that hype, there is a real structural shift here. The entire internet was built for humans who search and browse, compare options, click on ads. Agents, they don't do any of that. It already knows what you want, or it figures it out in the background. So it doesn't need to browse 10 hotel sites or read any reviews. It goes right from prompt to transaction. The agent, it may still access that data, but it does so through APIs and data feeds. It skips that front door. So for investors, the question
who loses when the user is not human. It's an agent. Well, the winners are the endpoints, the pipes. So airlines, not Kayak, hotels, not Booking.com, your bank, not the nerd wallet that sits between, and infrastructure companies like Stripe, Plaid, Shopify. CEO of Box, Aaron Levy, he told me yesterday that agents need everything an employee needs, like email, storage, a whole identity, and that could actually be 100 times their existing customer base. And so that could be an entire new category, not software as a service, but software for agents as a service. And that is why Jensen Huang is so hyped on OpenClaw. It's a personal AI that runs autonomously on your machine all day without being asked or waiting for a prompt. The creator just got hired by OpenAI, and its momentum, like Jensen Huang said, is really unlike anything that we have ever seen before in open source. Now, the market is starting to sniff this out. Stocks like Twilio and Shopify, these are the plumbing that agents actually run on. They're rebounding big time over the last month, and that's helping drive the IGV back from that February sell-off, guys.
I'll tell you one thing, the way you're talking about it, Dee, that whole notion that Jensen Huang talks about digital employees and human employees really kind of comes into full view.
It absolutely does, and that's why, someone like Aaron Levy says that could actually be 100 times bigger than its existing customer base. But that also leads to a lot of complications, right? We kind of saw that. Remember when we talked about Moltbook, when agents started talking on their own behalf and chatting with each other? There's a lot maybe a lot of duplications, a lot that isn't exactly necessary. A lot of the folks that I talk to in Silicon Valley say that they're kind of trying to solve for that exact problem right now. But even that feels like we've entered this new chapter where we're trying to figure out how to make agents more effective and how to give them those identities. So it's a really interesting debate here. And I will note, some of these companies that are the middlemen, like the Booking Holdings and the Kayak, they're rebounding along with the software trade. But remember, the selling was indiscriminate in the first place. Buying seems to be going that way too, the rebound. But when you start to look at the winners and losers through this lens, that could be a really interesting opportunity for investors.
Why? Because they aren't winners, you're saying, in this in this situation. It's more
they're not winners.
Twilios or Salesforces.
Exactly. They're not winners because agents don't need to look at Booking.com. They're doing that through APIs and data sets. They do not need the front door of the internet, which was built for humans. Agents just need to get in there, get the data, and do the transaction on your behalf.
Yeah, I mean, there was this one headline in the information this morning that suggested maybe OpenAI was scaling back some of their e-commerce aspirations. That might have been one reason they were trading a bit higher today.
That'd be good for them.
Yeah.
Right. And ads instead, right? And that's actually raises an interesting question. If you have agents doing it, they're not clicking on ads either.
All right. Thank you, Deirdre Bosa. We've got a market that is still selling off despite some of the bright spots in the software industry, the chips we've talked about as well. Energy is working today, higher oil prices. Tomorrow we've got a jobs day and a great interview for you. Fed Governor Stephen Miron will be joining us. Of course, he's a voter, and we'll get his first reaction to the jobs report. He has dissented in every meeting that he has been present in favor of lower interest rates. And the Fed has signaled that it's pretty much on pause here, unless we get something, I don't know, crazy, unexpected tomorrow. So it'll be interesting for him to make his case for lower rates. Expectation is 50,000 jobs added for the month. Unemployment rate to kind of stay around these levels.
Right. I think B of A is at 35. We did have Hammock last night suggest for an extended pause, and also some of the bets on hikes at the ECB. I think they're now pricing in maybe 18, 20 basis points of hikes for the year.
We've had this little perk up of inflation, and now there's a debate about whether central banks should do something about it or kind of wait to see if they can get back to making progress on inflation. It's a good debate. Beth Hammock is Cleveland Fed. She's a voter now. And yes, she has been one of the hawkish ones, more worried about inflation than jobs. I do think we are getting more and more evidence, and we got it today in the jobless claims numbers, yesterday in the ADP report, that the job growth slowdown has a lot more to do about just the supply of workers than demand, because wages aren't deteriorating and layoffs are not picking up that much. And so, that's not like the recessionary stuff where businesses are all of a sudden pulling back.
Right.
But it'll be a debate.
The problem is wages on a real basis, and real disposable income in the back half of last year kind of flat. And, you know, a lot of these inflation numbers that we're going to get next week will be dated already because of what's happened in the past 5-6 days.
Yeah, with higher oil prices.
Yeah.
Oil's rising again today. I think question is just the sustainability of that move and whether it'll have really a profound impact on gas prices and consumer pocketbooks.
Yeah. We'll see what we get in the morning. In the meantime, as Sarah said, still trying to hold 6,800. Let's get to the judge.
All right, Carl, thank you very much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, riding the volatility with stocks. We are sharply lower. We discuss and debate with the investment committee as always. And joining me for the hour today, Bryn Talkington, Carrie Firestone, Jenny Harrington. Let's check the markets. Guys, just told you we are red across the board today. Dow is sharply lower. The Russell is as well. NASDAQ not so much. And the S&P is kind of hanging in, down 2/3 of 1%. Oil's up. Gold is down, dollars up, yields are up. So that's kind of the backdrop, Bryn, as we begin our conversation today. I think the central question remains whether to buy the dip or not, because these moments, as we know, they cause volatility. We know that. They often don't cause worse, okay? So I would suggest that these moments can be, for many, paralyzing. They can also be opportunistic. What do you think?
I think, what's your time horizon, right? I think that's what investors need to ask, what your time horizon. And buy the dip, it's like we have so many sectors to buy the dip. Do you want to buy software dip? Do you want to buy financial dip? Do you want to buy the Korean dip, private credit dip? And so there's a lot of opportunity, whereas the S&P is still flat for the year. I think the equal weight's up about 5. And so I do think that, especially within software, the software ETF, all those stocks look identical from a chart, which tells me that there's a lot of opportunity there. I think also financials are another opportunity there. So I think there's lots of spots that people can go in, do their own work, and buy some individual names that have been unjustly, let's say, sold off and where fundamentals aren't meeting the actual reality that the stock is trading today.
We'll get through a bunch of the different sector moves because they are interesting today. I love the context that you put, and at times like this, context is more important than anything. The S&P's down 0.2% on the year. So we've run a lot and we've gone nowhere. What do we do as we look at the backdrop, what's happening geopolitically, and we realize that the story at home is still good? And until that changes, why would you react to something so far away, even as serious as it is?
So if you're asking me, should you panic and go jump headfirst into it?
No, I'm not asking you if you should panic.
No, of course not. Of course not.
That wasn't the
Okay.
question.
So,
whether you should panic.
Okay, I misinterpreted. Of course, the market looks forward. The market has been through its share of wars and skirmishes and geopolitical events, and generally, if you look a few months later, generally, it's calmed down and something has reverted back to at whatever level we were previously. So this is another example where we have sort of an explosion, literally and figuratively, that the market goes into some sort of oh my God phase. But here we are, and it's a few days later, and companies are reporting, and Broadcom had good numbers, and NVIDIA and Jensen Huang talked about where they're selling their chips and what those chips will be doing, and the software stocks were oversold, and people are buying them, and the non-software or heavy-duty industrials, et cetera, were a bit overbought, and so people are selling them. And that's the way I would interpret it.
You kind of answered my question in a sense when you talked about, unless there's some kind of, oh my God, moment, you think about what are those moments at times like this, right? Is it oil to 100? Is that okay, now you got to start thinking about the inflation picture, the ripple effects into the economy picture, and all of the ancillary things that would obviously be impacted by a spike in oil to that magnitude, the Strait of Hormuz being closed or ships actually being attacked or things that would change the calculus. My point and my question at the top is X that. Do you sit back and you say these are moments that have great opportunity along with them for long-term investors, like ostensibly most of the ones who watch our program, despite the tactical nature of some and the various things that people do differently than some others?
For sure.
And this is why I love being an active portfolio manager, because I can get super granular right now. So I'll give you a great example. A couple days ago, we added 5 positions to our international, not 5 new positions. We added 5 positions from our international portfolio to accounts that don't own them yet. Because with international stocks collectively being up 40% over the last year and 3 months, we've been really hesitant to broadly just buy the whole portfolio. But you wake up one day and you've got stocks in your portfolio down 7%, and they're totally unrelated, and there's no real consequence from whatever does go on in the Strait of Hormuz. So we added Veolia, Honda Motor, Nordea Bank, Seki Sui House. And those are some great things to add when they're down 7%.
Did you tell our producers about all those so they can throw them
No, sorry,
up?
it was a couple days ago. I didn't think we were going here with international. So sorry, I didn't, and it was adding existing positions in the portfolio.
Well, I just want them to be able to put something on the
All right.
screen that shows our viewers, because you ran through those so quickly.
You want me to say? I'll say them again.
Yeah, do it again, please.
Veolia, Honda Motor, Seki Sui House, Nordea Bank. Oh, and DHL was the other one. So it's nice to be able to take advantage. And then in the equity income strategy, I said, okay, who doesn't own Columbia Bank shares? Because that company's fine. So you can pick off and see where there's opportunity. But I like it too, in that you do have opportunities where, I mean, last year, if you look sector by sector, it's pretty bifurcated. This year, I feel like it's even more severe. So you've got consumer staples up 13%. You've got consumer discretionary down 4% on the year. Within all these sectors, there's enormous rotation and movement. Now, I'm not super heavy on the software side, but within the software space, if you know that space really well, like opportunities being created there. I can't tell you which ones are new and exciting today, but if you know that the way we know international, you can buy things.
I think some things are unanswerable at this moment. I think people can think that they know about software, but I would suggest to anybody who says that they know doesn't know, because it's almost impossible to know what the disruptive force of all this AI is going to be on software companies. Some are going to have a severe problem, and they're going to be severely impaired. Others may not. We're still trying to figure out who's who and which bucket each of these companies falls into.
I think within software, Robert Smith, who founded Vista, right?
Yep.
He founded, he's been there forever.
Yep.
He put out a video the other day. I thought it was very, very, very logical. And he made the point that, yes, is seat-based going to have to change, right? Because let's just take that as we're going to have less seats.
Yeah, less
with more
seats with more agents.
So then he would say, well, I think that because this does cost to do compute, we go then to a work-based, where you have now, instead of 10 people, you have 5. Those 5 people are doing more work. Guess what? That work costs money to do the compute. And then in addition, I think what's so fascinating is he said that less than 1% of enterprise data, like the data at my company or the data at Exxon or have you, is actually being trained inside of AI right now. It's really just the internet, and that's the opportunity. And I do think that, yes, maybe these software companies, the multiples going forward just need to be lower, right? They need to be lower.
Well, that's what's happening now, right?
Right.
They're re-rating for a rethink on where the revenue growth of that industry is going to be 5 to 10 years from now. That's the whole point of the pullback.
Right. And so the point is that I think the narrative does get a little disconnected to potential future fundamentals, because when you listen to Salesforce earnings, which once again, I bought it, I sold it, because I just can't get my arms around like these questions we're asking. But I do think when you listen to these software companies' earnings, they are still doing very well. And so if you put a lower multiple on them, they're not going to zero. And so that's where, like, I own a Zoom. I can get my arm around Zoom all day long. I think there's not that much downside. I think there's good upside. But you have to do that individually, because I said at the front of the show, all of those stocks, the charts look identical, and they're totally different companies.
The question is, Jonathan Krinsky put forth the other day, is whether the software stocks that have been down a lot are washed out. And you've seen some stability in the space. As we know, the IGV is up 7.5% in a week. Cyber's having a great week. Palantir's up. Bryn was just talking about some SaaS names like Salesforce. Snowflake's up. We've watched ServiceNow. All these names that we have talked about on such a consistent basis, and frankly, most of it negative. Is it bottoming, do you think? Because Microsoft, if you want to throw that in there too, look at the chart. We show it every day. Pull a year.
So this is exactly the question that we felt would be important to answer. let's compare the old economy stocks that have been surging with the new, I'll call it the new economy stocks, even though Microsoft isn't new, but including some of the others. And we have a chart here that shows that the current, this is old economy stocks, and I had a bunch of them in there, names like Caterpillar, Deere, Emerson Electric, Flowserve. This is where the forward PE of these stocks, or the group, the average was 30 times, and giving them the benefit of good earnings growth, we look at 11+% this year and 17+% next year. Then we looked at how are the new economy, the software stocks, such as where are they trading? 21 is the PE. So these stocks have come way down in PE and their growth rate. And these are numbers that I reduced from estimates that we had been using, and they're still growing faster than the old economy stocks. So I don't know whether the run-up was too much. It certainly was fast, or the run down too much. We know it was fast, but it appears to us that there is now this sort of disequilibrium where there's too much buying in these stocks that are cyclical.
I'm glad you used the word disequilibrium, because I was literally going to use the word equilibrium, because it's another one of Robert Smith's favorite words. As he talks about different things in this part of the business, and maybe these names need to find their own equilibrium. And maybe they're in the process of doing that. Have they been washed out? We'll find out in the days ahead. I asked the question I did at the very top of the program, what do you do? Because as I said, these moments can be paralyzing, but they can also be opportunistic. Now, what I'm going to read you next was before the war broke out, okay? It was before the weekend. It was talking about February. February finished, according to Retail Radar, as the third largest dip buying month on record. That's pretty interesting. So there's still an appetite to believe in the prize at the end of the rainbow, right? That this now, even with the variables of war and geopolitical things that come into the conversation that weren't there in February, but are now, there are those who believe in the prize. What were they buying? NVIDIA, Palantir, Microsoft, and Broadcom, which they were obviously smart to be buying Broadcom before that company reported earnings. Take a look at the stock. There it is. As Christina Partsenevelos joins us now with the headline, Broadcom just did what NVIDIA couldn't. Explain.
Yes. And the reason you're seeing Broadcom move right now post-earnings really comes down to what CEO Hock Tan just delivered on the call yesterday. A convincing argument for why this growth lasts. NVIDIA last week, no doubt, put up monster numbers, but yet the stock still fell, partly because of that scale of being so big and ownership level. Every single person knows NVIDIA now, and it takes more than a beat to just move the needle. Broadcom is a relatively different setup. AI revenue more than doubled. Its software business won't get hurt by AI, according to management. And CEO Hock Tan gave investors a line of sight to more than $100 billion in AI chip revenue just by 2027. OpenAI was also confirmed as a sixth customer. Memory supply is locked through 2028. That's the first time I've heard a company actually say 2028. And management put the margin question around AI racks to rest, something that has been hanging over this stock for months. The CEO also addressed the Google fear head on, the worry that Google would eventually design its own chips and cut Broadcom out. Tan said the complexity of building chips that can compete with NVIDIA makes that nearly impossible for years to come. And then we know NVIDIA is the bigger company, no doubt, but sometimes that's the problem. Broadcom had more room to surprise, and CEO Hock Tan went through the bear case point by point, or all the bear cases almost. Margins, customer concentration, supply, customer-owned tooling, and largely put them to rest. And so that's why you're seeing a different reaction in this stock, Scott.
Interesting. Such a good look for us. Christina, thank you. Christina Partsenevelos. You own, carry the stock.
Yeah.
They also, announced a buyback, a $10 billion buyback too, so they'll throw a little cherry on top of the quarter as well.
Yeah, it was a great quarter, and there have been doubters of Broadcom over the last several years. It's not a stock that really caught on until about a year ago, and it's been a fantastic stock over the last year. You know, we've owned it. I think that the more they focus on AI in their earnings calls, the more I think investors like it. NVIDIA, it's all really about AI. With Broadcom, they've had this mix, and it was less than half of the company. Now it's increased as a percent, and the market has become aware that they're in it, and a very, very strong competitor for people who can't get enough NVIDIA chips. It's a big enough market for them both. And that's why I think smaller company, less belief in it, more now appreciation of how much they can grow.
Street loves it. Target to 525. That's the high on my list today from Bernstein. They reiterate their outperform call. The low of what I saw today in terms of targets, target got cut at B of A to 450. So it's still substantially higher than where it is, obviously, now. They do reiterate their buy. They just pulled their expectation on the target down a little bit. What do you make of the mega caps this week? That's been a really interesting trade. We've been talking about it all week. Safe haven status, okay, treasuries, not so much. Mega caps, so much, right?
So as much as people love to hate on the mega caps, the tech stocks, Goldman, I think they do a good job on their earnings estimates. Estimates the S&P is going to do 305 in earnings per share. Of that, tech is $86. Okay, and then the growth for year over year within tech is 26%. There's no sector even close to that. So it kind of goes to what Carrie's slide was even more broadly about you're still seeing the earnings growth. And then we actually went a little bit deeper. Broadcom is now the number 6 stock in the S&P. So yes, it's less well known, but it's moved up to number 6. I guess it was nowhere near that 2 years ago. And you're getting so much earnings power still from NVIDIA and Broadcom. And so I think that this is telling you, if you listened to Hawk Tan last night, this trade is alive and well. These companies' valuations keep coming lower, especially Broadcom and NVIDIA. And I think that when you go to say, where's earnings growth, where's cash flow, yes, their CapEx is crazy, you still go back to mega cap tech.
Oh, that's what people are doing. Amazon, by the way, reiterated by B of A. Apple reiterated outperform. Carrie at Evercore, you own both of those names too.
Yeah, I think that when the market gets in its head, oh, we can't stand this group, we're just going to, ditch it and buy new names. And it becomes an overdone calculation because these big cap stocks keep producing the numbers. They're out there. I mean, a year ago, I can't remember exactly, everyone was down on Apple. Nobody wanted to own Apple. Apple has been one of the better performing of these names because the 17 did much better than expected. So the same is true of Amazon. They keep growing, they keep innovating. The fact that they're now shrinking their workforce is positive for earnings. Remember, that company used to sell for 300 times earnings with the idea it was never going to have any cash flow. Now it generates a lot of cash. So things change.
And on Apple, they're not spending the CapEx. Their CapEx is actually down 19% year over year. And so you have this company that continues to innovate on product. They're going to partner with Gemini. They probably partner with some other folks as well. I still say this device that we all use is in pole position from a consumer perspective of how we're going to use AI going forward. So I think Apple, just for all of those reasons, high cash flow, low CapEx, we know they have great products, and Gemini is going to be just getting better and better. Every software release that Apple does.
Jenny's favorite name to hate on.
It is my
to
favorite
hate on.
to hate on.
You're a hater of this
I know,
stock.
and I actually feel like my hatred is fading because the valuation is becoming a little more reasonable. I know.
Wow, why don't you buy it?
Well, we're not there yet, right? Because it would go into our disciplined growth strategy, and that has that really high 5% free cash flow yield or better mandate. So we're not there yet. One of the things that I've been thinking about a lot, though, with respect to like why the Mag 7's underperformed, why Microsoft's underperformed, is I sit on some investment committees that are like much bigger than the portfolio that I manage. And one of them in particular oversees a few $1 billion of pension money. And when I sit on those investment committees, something that I'm constantly reminded of is how little human thought, human feeling, us saying like, hey, the growth rate's still great on the Mag 7. How much of that is out of the hands of us being creative, and it is just in the hands of natural rebalancing. And so I've been thinking a lot this year about how with that huge growth, I mean, I'm looking at something where it reminds me that in 2024, Mag 7 earnings growth was 40%, and the share prices really followed. So as we ended 25 and got into 26, you have these portfolios where no one's being creative and saying, hey, I want this much, in U.S. growth. They have long-standing investment policy statements that say you can have 55% here, you can have 35% there. So to some degree, there's a real mechanical undertone, I think, that's started to tip the scales this year. And then what we all know is you tip the scales and then momentum starts to follow.
But I do think the dispersion, though, is nothing mechanical about that. The dispersion between an NVIDIA or a Microsoft,
Agree
right? Like
with you.
Microsoft is stuck in the mud. Like Amy Hood, amazing CFO, Satya, everyone loves him, but everyone's kind of like, Copilot's kind of mediocre. What are we doing? You know, and so I still feel that within those names, there's going to be very broad dispersion of returns.
Right, and that's exactly why I said before, I'd much in this environment, what do you do and what can you do? This is why it's awesome to be an active manager. Because if you're an active manager, you can actually have outperformance in a year like this where things are starting to disconnect from each other under the surface.
We have an update out in San Francisco. OpenAI's Sam Altman speaking at Morgan Stanley's TMT conference there. We've been highlighting speakers throughout the last few days. Kate Rooney is there, joins us there from there with the highlights that we need to know about. Kate?
Yeah, Scott, we're here today. I was in the room with Sam Altman addressing the controversy around OpenAI's Pentagon contract. He was insisting on stage that they, quote, did not rush into that deal, and then also took some subtle jabs at rival Anthropic. Altman saying it's, quote, bad for society if companies start abandoning their commitments to the democratic process because, quote, some people don't like the person or people currently in charge. That is a nod to Anthropic CEO Dario Amodei, who reportedly criticized Altman's relationship with the Trump administration and, according to a leaked memo, called Altman's behavior towards the administration dictator-style praise to Trump. Altman also said on stage, quote, the government is supposed to be more powerful than private companies, and that the Department of Defense that they've been negotiating with understood the need for safety where the AI technology just isn't ready yet. He says there are times when the legal system has not caught up quite yet, and then in certain instances says the technology is just currently not safe enough, alluding to some of the red lines they've had and Anthropic had. Altman also saying the law is going to have to evolve fast right now. Also touting some of the recent growth in their coding agents, in particular the product known as Codex now has more than 2 million users, according to Altman, growing 25% per week. And then he did not discuss this on stage, but I am hearing from a source it's $25 billion for this company in terms of the revenue run rate. Got a rival Anthropic closer to $19 billion, according to sources. Scott.
So I just want your insight because I was confused by this comment from Altman, okay, that they did not rush into the deal with the government. They obviously rushed, and he seemed to admit as much the other day when he said it looked opportunistic and sloppy. So what is this? Is this just a little damage control on the stage in San Francisco today as they continue to try and save faces the way this all played out?
Yeah, Scott, I think that's a fair way to describe it. Would be damage control. We heard him speaking to employees last week saying that, as you mentioned, opportunistic, sloppy, that they did appear to move quickly, but at the same time saying that this is an important contract, really trying to lean into the importance of democratic values and position himself differently than Dario Amodei and some of the pushback he's getting. And so it's become a divisive topic where both of these CEOs really can't win, because if you're seen as partnering with the administration in some ways, there are questions from employees about safety. And then on the other side, they're just getting it from both sides here. So Altman very much dancing around this topic in general and has to toe the line of working with the administration, but also making sure that his AI employees out here, they've had protests outside of their office. So he is really trying to be diplomatic in some of this conversation. And I think he tried to play it safe, but also really is trying to underline, clearly kind of speaking to the administration in some of these comments, saying we had to do this deal. And in some ways it wasn't rushed, but you're right, where it's in contrast to the message we heard with him talking to employees last week. And it's evolving. They have evolved their message, and it's been fluid. So we're getting updates on this pretty much every day, Scott.
All right. Well, it's interesting stuff, of course. Kate, thanks. That's Kate Rooney.
Yeah, that's a good point.
Out in San Francisco, as we saw. Do you have any comment here?
Well, I mean, he's a master evolver. Okay, it's like a nonprofit profit. It's like da-da-da-da. Obviously, Sam Altman is a master fundraiser. That is crystal clear. He has just crushed it raising money. And who Anthropic steps out, obviously he was going to step in, right?
Yeah, that's right. This is not even a critique of whether they rushed or not. That's who cares about that. It's just, it is what it is.
It actually, absolutely.
If they saw a tremendous opportunity open up at the last minute, and didn't want to miss out on it, they obviously reacted how they did.
Correct.
Some have issues with the way that they did that and the message it might send to others who are out there in the same competitive game that everybody is trying to get ahead in.
But ultimately, look at Palantir, right? Palantir, I think, has done a obviously, Alex Carr is so colorful, right, in his personality, has done a very good job. And I think one of the main issues with this Pentagon contract is, are you going to spy on us? Right? Are you going to use this to spy on us? And that's really one of Anthropic's issues. Palantir's done a great job. They don't do that, as far as we know, right? And so I think this is where how much do we trust? At the end of the day, with this stuff, I think it'll come down to how much do we actually trust OpenAI and/or Anthropic with all this data.
We're not going to be able to answer these questions for an awfully long time. They're legitimate questions, but they're larger societal issues as we all try and get our arms around where everything's going. Can't answer that today.
No, and you know what's interesting? Yesterday we had a big long meeting at our firm to say, okay, we really need to start using enterprise level AI. And are we going to use ChatGPT or Claude? Probably both. But the part is look, we're pretty sure we can't trust them. We're pretty sure even if they say they're not going to steal our data, they probably will. But you also can't move into the next 10 years of your career and your business without using them. So you're exactly right, Scott. We won't know. I think we probably can't trust them, but you also have no choice. It's a really hard position to be in.
We're going to squeeze a break in. We'll come back. Jenny's got a new buy to tell you about. Don't want to miss that. A lot of retail names are on the move today. Got some good calls ahead of us as well. We'll step away. We'll come back and we'll do all that ahead. Market deteriorating just a bit. Certainly the bigger stocks within it. That's represented, of course, out of the Dow, Goldman, Walmart. Some of the healthcare names we could cycle through. J&J, Amgen, Merck. Show you exactly where the point of weakness seems to be the most acute. Goldman Sachs has not traded well lately. The banks have not. We got obviously the private credit and just credit in general. What are you thinking about as you see, all these groups and these names which just have not traded well lately?
No, I think right this moment, maybe there's something happening. The market sniffs this out. Maybe there's something happening with Iran that we just don't know about. But I think these groups as a whole, especially the financials, which have been trading poorly all year, is saying, Are we going into some type of credit cycle that no one's expecting? Are we going to go into some type of recessionary environment? I don't see that. I don't think anyone sees that. But you do have to. I do always respect what the tape is telling me.
Yeah, respect the tape.
I definitely
you
respect
have to,
the
right?
tape. And so it's like, what is Goldman down 3.5, and it has traded terrible all year, telling me? I think that if you don't have recession, once we get past these private credit headlines, and once they either the headlines are the headlines and the facts are the facts, I think this is an opportunity, the financial system as a whole. I mean, I own Capital One. I think it trades down 1% every single day.
I mean, there is a view, and it was in fact a note that was out, from some firm today that said banks should be AI winners, as efficiency ratios are ripe for gains. Now they have a lot of the regionals within that.
Well, but you would also think with the regionals, the deregulatory framework, which we really haven't seen. Rates coming down, good for regionals. The deregulation, good for regionals. Real estate is stabilizing. Those should do well also. But the tape down almost 2% is telling you a different story.
Yeah, I've been trying to figure it out too, because we were saying before the show, I'm like, this is such a weird market. It's hard to get our arms around. And I asked my team, I'm like, what's going on? Cat, Goldman, Sherwin-Williams, like really different things. The only thing that I can say, and it doesn't even really count for Goldman.
Brent's up. Brent's pushing 85. WTI is pushing 80. So I mean that. If you continue to see oil creep higher, you're likely going to see stocks go lower.
I think that's right. And then you've got, don't forget interest rates too, 10 years at 4.14. So you've got these things, but they're not really company specific. But then you've got CAT at 30 times, and I think that's really it. It's just a broader kind of macro thing. To some degree, it's just the composition of the Dow where, it's price-based. So the higher price stocks have a big weight in it. With respect to the regional banks, I think that's a hard one. And I've been really challenged by that. Before I said I added Columbia Bank shares, COLB, to accounts that didn't own it. And that was because it's down so much, it's super cheap. Theoretically, if housing stabilizes, if the consumer doesn't fall off the cliff, that company should be fine. But I'm not really buying the AI efficiency at the regional bank level. I think that that's going to be so broadly spread out, and frankly, the bigger guys are going to be the bigger tech winners overall, that I don't think that ends up being a huge boon to them. They're just inexpensive.
So here's just a thought on banks. Morgan Stanley and Goldman Sachs both hit all-time highs. Were fantastic stocks last year, on the belief that the economy kept going and there'd be a lot of deals. Well, the deals have not materialized in part because of the geopolitical issues. So it could be a combination of, it hit a point with people selling, profiting, and not enough business on the banking side.
That's a good point.
So we're at the lows, obviously, of the session, 965 for the Dow. What's even more interesting is over the last few days, you've had a lot of notes say that, hey, we think that money's going to continue to come out of the small stocks and the mid-cap stocks and go into the biggest ones in the market for obvious reasons. Go big or go home if you're worried about, safety, security, and whatever else is part of the story, right?
Right, because that's also a rate story. The smaller you go, the more important rates are. And so, rates were at 4%. 2 days ago, they're what, 4.16 on the 10-year. And so you also have that the SPR, which we haven't talked about, we never refilled it in earnest. It should have like 700 million barrels. I think we're in the 400s. And so we did not ever take that opportunity with either Biden or Trump to fully refill that. And that's not great for us right now to be able to keep oil prices down. And where I come back to that, that's not great for the consumer, which I think the economy, and then small caps as a derivative of that.
Right, because small caps frequently have more cost pressure from oil, and they have higher leverage, so they get a double whammy.
All right, let's get the headlines with Dominic Chu. Hey, Dom.
All right, so Scott, the Department of Justice is planning to release a new batch of the Epstein files, quote, fairly soon. That's according to MS Now, citing people familiar with the matter. Now, it comes a day after the House Oversight Committee approved a motion to subpoena AG Pam Bondi over the Justice Department's handling of those files. Congress passed an act last year to release all of the Epstein files, which the DOJ has yet to complete. New York is leading a group of states that will sue to block the Trump administration's latest round of tariffs, which he imposed after the Supreme Court deemed his prior tariff policies unconstitutional. New York Attorney General Letitia James called the tariffs, quote, a clear attempt to escape the Supreme Court's ruling. And Ben Affleck has sold his AI-powered filmmaking company Interpositive to Netflix for an undisclosed sum. Affleck said in a statement that the AI tool is meant to, quote, preserve what makes storytelling human. AI has been a difficult topic in the film business. Limiting its use was a major focus of the SAG-AFTRA writer's strike back in 2023. Scott, those are your headlines. I'll send things back over to you.
All right, Dom, thanks very much for that. Dom Chu. Up next, Santoli's going to join us to talk about this market. Dow's down 980. We have a 900-point decline on the Dow, as we've been showing you. Our senior markets commentator, overtime co-anchor, Michael Santoli is here at Post 9 with us. What do you think about this?
I mean, it's not that much more complicated than crude presses the highs, the volatility index is up, and even before that, you had like 70% downside volume. The market's been trying to kind of rotate around, but also in this forced way, right? I mean, I don't think there's a lot of conviction in the individual software names that are ripping today. But there is a lot of squeeze action. We're selling the momentum winners, buying what's left behind in the past several weeks. And beyond that, I do think the market wanted to get to a place where it was not going to foreclose on the idea that this could be contained, relatively brief, and not very disruptive. So I think the kind of the market has been in that spot for a while, trying to see if we can defend this 6,800 area, which is now, you know, kind of broken again. Everyone knows you buy the dips on these geopolitical events. You don't always just buy the absolute first dip that you're 3% from record highs. I think that's what we're trying to sort through.
There's just a lot to get through. There is, although the stocks are trading better today, you have consistent concerns about private credit.
Sure.
The BlackRock headline of today, they slashed the value of a private loan to zero, only 3 months after assessing it at 100 cents on the dollar.
Yeah.
That's a confidence sort of hit again, sentiment-wise. Howard Marks was here.
Yeah.
Talked about, yeah, there are going to be issues, but not systemic. But right now, the market's just fixated on credit beyond private credit.
Right, trying to see if it does leak into it. It hasn't necessarily been that alarming and profound in most credit. So I think that's one of those things where, hey, it doesn't help. You know, when we have to worry about the front and center concern of this conflict and what the macroeconomic impact is going to be. But also, just there's been a squeeze financial tightening, right? So yields up, dollar up, VIX up, oil up. Equities have to reprice a little bit for that. I do think it's been somewhat constructive. We've been trying to find areas that aren't going to be impacted and trying to localize the damage in things like the airlines and everywhere else. I think it's worth a reminder. You know, we always, well, is Mag 7 going to be defense? The market doesn't always owe you a place to hide every moment that's going to be good in absolute return terms, right? You're lucky if it does, but sometimes it's just a matter of letting things kind of wash through the market and see where it comes out.
I do think would you agree that the most critical place to continue to watch this market's the banks? The banks are certainly high on the list. If not the most, it's got to be up there. The banks are not trading well, and as long as they don't, you're just going to have questions in this market about what is the economic fallout of all of this going to ultimately be? What are the credit implications of the concerns that we already have going to be?
I also think popular long coming into the year. Any popular long coming into the year has had a little bit of a gut check along the way. Morgan Stanley, they had this report of, you know, a couple thousand layoffs.
Yeah.
Didn't really help the stock, and people are worried about, you know, the usual stuff. But I don't know. It doesn't seem to me like that's the epicenter of the concern right now in terms of credit contagion. It's much more about, you know, we're just taking risks down because there's so much we don't know.
Yeah, no, that's a fair point. Thanks for joining us. Yep. And I'll see you at 3 o'clock. We'll have a lot to chat about then. I look forward to that with Mike Santoli. I said we have some moves to get to. I promise we'll do them next. Welcome back. We call your attention to shares of NVIDIA, which aren't helping the market at the moment. You can see a pretty substantial move lower in the last few minutes. Christina Partsenevelos has some news for us. What are we learning here?
So the Trump administration is supposedly drafting rules that require U.S. government approval for nearly all AI chip exports worldwide. And this is according to Bloomberg right now. And so that would be a significant expansion of existing controls rather than just banning sales, like let's say sales to China. It sets Washington up as essentially a gatekeeper. So small orders get a simple review, large data center builds would need pre-clearance, and then the biggest deployments, think about 200,000 plus NVIDIA GPUs, would require the host country's government to negotiate directly with the United States and make matching investments in American AI. So that is the story why you're seeing the stock react down 2%. But from what I know, based off of contacts and what we've seen in the past with these drafts, agencies like the Commerce Department often share papers, legislation, drafts like this all the time. We know the Trump administration and even the president itself, they have been very forward-leaning regarding chip exports. They want the U.S. companies to send their chips abroad. So if this framework would be true, it would replace Biden's diffusion rule, which President Trump in the past has called too restrictive. So that's why I would just take this with perhaps just a note being passed around. They have to consider all options, but may not necessarily be the outcome. NVIDIA is not commenting. AMD didn't answer my phone call.
It potentially extends beyond just those two companies, right?
Yeah.
This is just an example of what is mostly impactive to NVIDIA because of the size and scope of their chip business and their desires to export them in places around the world. It is an AMD and the others that you follow in that space too.
Even Broadcom, because of the business that they do with ByteDance. A lot of American chip companies do business, and I'm not just saying China, there are other countries around the world too, and all of the subsidiaries too that have placements in Singapore, Malaysia, et cetera too. This could impact a lot of these names across the board if this draft were true, which we still don't know is even being considered.
The other thing is it underscores, I suppose, and the article addresses this, that has moved all of this, that America has tremendous power over the global AI ecosystem, if you will, right? We have the best companies, we have the best technology, we have the most powerful chips, and we want to have a bigger say over who gets to use what and where. Frankly, whether they like it or not. And that is a reality that these other leaders in these other nations are going to have to wrap their arms around as we talk about issues as substantial as these.
Well, you mentioned the other leaders. Think about the CEOs of these companies too, knowing that their business that they worked, decades to build and build up to these behemoths are now being used as negotiation tactics with foreign countries. So yes, the control is with America, and this is definitely a bargaining chip, but I'm sure it's not something that a lot of these CEOs are going to take lightly, like NVIDIA, Oracle, even Microsoft. It would affect so many companies.
Yeah, Christina, thanks. We'll hear more from you, I'm sure, throughout the day. That's Christina Partsenevelos. We will do those moves. I promise you next. Scott, tough day. Dow down 950, as you saw there. Okay, let's do these moves. I promised. It's worth the wait.
Let's hope.
So, Best Buy the other day reported disappointing holiday sales. Okay. Are they showing progress in some places that led you to want to buy that stock because it's a new buy of yours?
So it's interesting that it was perceived as disappointing because the shares were actually up almost 14% pre-market, and that was the day when the market was nasty, down 2.5%. So I was able to buy it at only like 4 and 5% during the day from where it had closed. So it was about $61. So here's the numbers: 5.9% dividend yield, 10 times earnings. By the way, the dividend is $3.84, which is more than covered by $6.50 of earnings. So when you say they reported disappointing earnings, I'm like, hey, that's great. And it also shows a positive progression. They actually bumped the dividend on that call by 1%, and they announced a $300 million share buyback for fiscal year 27. So the numbers are fantastic. They've got a $13 billion market cap, only $1 billion of debt. One of the things that they do with their huge free cash flow, which this year should be $1.1 billion, next year $1.5 billion, is they keep the debt low, they pay out earnings. Okay, and so here's the story part of it. The story part of it is, to me, this is a play on hardware. And also, I think this kind of hardware has become more like consumer discretionary versus staple. So computers, phones, there's been a huge supply chain disruption because of memory. They're still coming off of COVID, but I think there will be another upgrade cycle of PCs, and they'll be there for it.
Carrie, you bought more Novo. That's your story, right?
Yes, exactly. So Novo is the stock that I own in our charitable trust. The reason that I bought it, it's down 72% from the peak. I first bought it when it was down well more than 50% from the peak. It's clearly lost ground to Lilly in the GLP-1 battle, but the battleground is enormous. And it's 11 times earnings with potential to really grow its earnings from different indications, and they have a strong pipeline.
Okay. We will break. We'll come back, and we'll do finals. All right, 3 o'clock closing bell. Dan Greenhouse, Anastasia Amoroso, Chris Heisey, Kevin Simpson, Mickey Drexler. Looking forward to that. I hope you join me then. See what this market's doing, too. We're down about 950, 960 on the Dow. What's your final trade, Jenny?
Okay, Flex LNG, 10% yield. LNG transportation disruption is good for their earnings.
Okay. In the headlines for certain.
Yep.
Carrie.
Roughly in the energy field, Nextera. It's a utility, but one of the sustainability plus ones.
Bryn.
Zoom.
All right. Thanks, everybody. The exchange is now.
Thank you very much, Scott, and welcome to The Exchange, where the sell-off in stocks today is picking up steam. I'm Kelly Evans. The Dow is down almost 1,000 points as oil prices are on the rise again, and the yield on the 10-year is back above 4.1. It's at 4.14% this afternoon. Oil is surging over $79 a barrel today after Iran says it attacked a tanker. WTI, keep this in mind, has not traded above 80 since January of 2025, so in about a year's time. The oil and gas ETF, the XOP, is now at a 4-year high. If there's one positive standout other than in the energy complex from the investor side, it is the software space again. The cloud ETF, WCLD, is on pace for its best day in nearly a year. Names like MongoDB, Monday.com, Okta, and DocuSign are all up 4% or more as those CEOs and earnings try to dispel some concern about software being disrupted by AI. But let's start with the sell-off in the markets and the rise in both oil prices and yields today. I'm joined by Drew Pettit. He's U.S. equity strategist at Citi. And Drew, the markets are going, day by day with this, and so far not liking the continued, the fact that this war is dragging on.
Yeah, I think, honestly, equity markets here are really taking cues from the oil markets. We saw this in Venezuela early in the year, but again, markets moved on from that pretty quickly. Oil vol settled back down. I would say index vol in the equity space came down as well. Right now, you're still seeing oil vol spike higher, and the VIX is going to chase that higher. That leads to these sell-offs. The good news is it's still not completely correlated. There's still dispersion. That's why this isn't really as bad as it could be. And names like software obviously helping the index not be down any more than really what it is so far.
But the whole story for you is the price of crude?
Yeah, because look, the really strong earnings story to start this year has been on the cyclical side. I get software has beaten raised. I would say semis have as well, but AI disruption kind of denting that narrative. On the cyclical front, you've had really good macro data. And again, a lot of that's backward looking. Productivity this morning, very good. But when you think about oil prices now, the forward looking implication is those inflation differentials are going to be a negative. So you're finally hitting that side of the market, which had actually gone up a lot. So we're denting the cyclical narrative with oil prices. That's what's really been driving the market for most of this year.
It's a great point. You mentioned this yesterday. The folks over at Piper Sandler think that this could add a point to CPI, which is going to be a really tough story for the Fed.
So the Fed doesn't really live on CPI. I would just like to remind people that they live on kind of core PCE or trim mean PCE. That's going to kick out some of the, I would say, initial and immediate energy impacts. I get it that there's going to be some cost pass-throughs in some other areas where, look, you can't completely disentangle the oil story from inflation. Where this hurts the most is going to be consumer and something like consumer staples. Well, guess what? Those defensive trades that people wanted to pile in, I would say the bad side of Halo to us, they're not providing defense when oil's up. So again, we still feel comfortable with industrials and those types of names on the industrial, I would say production side of the economy, consumer side, that to us seems worse. You don't really have a good fundamental narrative to withstand higher oil prices.
It's really interesting what you said about consumer staples, which had been the third best sector until recently, partly on this idea that they can't be Gen AI'd, and maybe there's some other factors at play there as well. So now you think this is, you had a great way of putting it, kind of the worst part of the Halo, what is it, hard asset, low obsolescence trade. So what should people do then? Get out of that sector, and can industrials be okay when we're talking? I mean, look at jet fuel prices. They're at a 4-year high, and they peaked, to eye-watering levels earlier today in Europe.
When you look at the inflecting growth cyclicals, those stories don't actually get you into airlines and so on. it gets you into a little bit more of the infrastructure build. Those names can actually pass costs on. The margin story there is pretty good. It's the areas where you can't pass along higher input costs where we get concerned about. The consumer is not as strong as, I would say, the business side of the economy that's spending out of free cash flow and actual benefits of immediate CapEx expensing. The consumer, yeah, they get some tax refunds, but they're not really in the healthiest spot. You're not seeing consumer companies pass along tariffs as aggressively. You think they're going to be able to pass along oil costs aggressively? Probably not. So the margin compression story on that side of cyclicals is concerning.
Yeah.
To us, keep owning growth, keep owning the industrial side of cyclicals. Don't be chasing this defensive low beta rally. It's not going to provide you defense because it's been bid up too much.
I know you said the Fed might look through a brief inflationary shock, but over in Europe, there's markets are already potentially pricing in a rate hike as they have to respond to what's going on with energy prices.
Yeah, this is where U.S. gets a little bit defensive in this area. We're a little bit more independent. Again, on the energy front, we're not getting hit as hard as Europe is here. Our strategists are a little bit more conservative.